You said the first misconception about everything that we do. Everybody focuses on an illustration. They don't understand the concept of what we just talked about moving the money. Because really, if they understood the concept, they'd never care about the numbers as much as you are. Think about it. Like, we have two alternatives for what we're talking about. You can put money in a bank account, maybe a money market, to have access and liquidity, or you could put money here and have access and liquidity. But one allows you to make money twice. The other allows you to make money once.
I noticed that people that would do infinite banking, if they have a business, an LLC, an S Corp, whatever, it makes more sense because you can then lend to that business.
Yeah.
So you become the hard money lender for your business instead of your business getting it from somewhere else.
Yeah.
If your business was going to pay someone else interest, why don't they just pay you interest?
I'm going to talk about a concept you guys maybe heard me hate on a little bit, but this guy's going to enlighten me with everything we need to know about infinite banking. Along with that, we're going to talk about some different things with the private money club that he just started and ways that, you can get connected with private money. So I got none other than Chris Noggle. What's up, man?
Not much, man. Thanks for having me on.
Yeah, dude. So what do people know you as? Because when you first came in, I'm like, you're the infinite banking guy, right? And you're like, yeah, but there's a lot more than that.
It depends. I mean, some people know me as the pro snowboarder. Other people know me as the HGTV guy. Other people know me as the infinite banking person. Some people just say, you're the money guy.
You're the money guy. Dude, I didn't know you were a pro snowboarder. Tell me about that.
Yeah. So, 19 years old. Well, it went back before that, but 19, I went pro and did a pro career for a long time. Got taken out when I was 34 years old out at Mammoth, overshot a pretty big table. And that was it. But it was honestly one of the most magical periods of time. And it fed my business too. So back then I owned retail stores, skateboard, snowboard shops that I started when I was 17. And so I was running the shops, doing the snowboarding, perfect life.
When, where did you grow up at?
Buffalo, New York.
So
not the Mecca for snowboarding.
Yeah, but it's cold.
It is. Yeah.
Yeah. So, I obviously, I started snowboarding a few years ago, once I retired from baseball because I didn't want to ever get injured, and so I think in 2017, I retired from pro baseball and it's like, I'm snowboarding. And I also bought a cabin in Big Bear. And so I just started snowboarding and dude, it's so much fun.
Oh, it's a freedom. I mean, I try to explain to people like what I feel when I'm up on the hill, but I'm a kid again. I'm 45 now, but when I'm on a board, I don't feel 45. I can be 19 that day, depending on what I'm feeling. It's a magical place.
So will you still like just go grind rails and do some big jumps and stuff?
Yeah, just look at my feed. You'll see last winter, we're just blasting tables and rails. Like I said, I don't know any different.
Right.
A couple of years ago, I started competing again, and then I had two bad injuries that kind of made me realize, okay, maybe we can just go have fun with this.
Right. Is snowboarding like kind of like the race car drivers and jockeys and stuff where you got to be smaller because you're a smaller guy?
Yeah. I don't think it hurts you because obviously, it's less distance to hit the ground, and we hit the ground a lot, and I rode with a lot of tall guys. They always had knee problems.
Yeah.
I mean, I've blown both my knees out, but my knees recovered. The tall guys just never seem to recuperate from it.
No, dude, I would think snowboarding as a tall guy would be tough because like Shaun White, he doesn't seem like a very big guy.
Not at all. Not at all.
Yeah.
No. Most of the guys that I snowboarded with were relatively short, let's say 6 foot and shorter, but 6 was like,
that guy's tall for
that
snowboarding.
Guy's super tall. Like, oh man, he's lanky. But most of us were just little guys. So
Yeah.
it was perfect.
It's funny because it's like the opposite of other sports. I'm 5'10", and I was always the smallest guy on my baseball team. These pitchers are all 6'5" and huge, and but then I see these other sports where it's actually you have an advantage being smaller.
5'4" and rocking it strong.
Yeah, that's funny, man. I got one question about snowboarding. So I always get so scared when I go straight. Like I always have to be carving to kind of slow down. Like how do I get over that?
You could detune your edges. It would take that edge away because if you're riding like a factory tuned board, then you're on a hard packed surface.
Yep.
Riding flat is scary because you get that feel of those
Like
edges.
I'm going to friggin'
Correct.
Yeah.
So if you just take and you put the board flat and you just take a file and I just put my fingers under it and you detune it, you can get, a bevel on that edge, which will make the board just ride it'll kind of be looser,
Okay.
but don't expect it to like when you nail the edge to hold on rock solid ice.
Got it.
But that's like all the rails that we rode. A lot of people don't realize this. All the riders, we detune our edges a lot. Sometimes we just take part of the edge on the effective part right off so that when you're sliding the rail, your edge isn't in contact with metal. Because metal on metal equals a broken hip. I can tell you all about that. So you detune, you make the board work for what you're doing. And we never had just one board either.
Okay, that makes sense.
So
Yeah.
try that.
Yeah, I'll try that out because like Big Bear, I'm sure you've snowboarded in
Yeah,
Big Bear,
yeah,
right?
love Big Bear.
Yeah. It's
That
like
beautiful lake down at the bottom.
so nice, but the snow is always man-made and
Mhm.
it's not super fluffy, and so I'm like, "Dude, I'm gonna, like, fall and this is gonna hurt."
Absolutely. Yeah,
Yeah,
and maybe, different boards can help that too. Like there's the reverse camber or the hybrid cambers, not getting technical, but that helps with that like looseness.
right. So, I mean, dude, how do you go from pro snowboarder to being the money guy?
Yeah, it's interesting. So living the life all the way up to the 2000s, just doing snowboarding, running my shops. I had 3 locations, and I remember the day I just gotten back from California because I was at a trade show, and I'm driving to my store, my brand new store, and on the radio I hear of this plane hitting a tower, and I'm like, "My gosh, some poor guy just hit the tower." And then I later we learned that was 9/11, and
Mm,
then following 9/11 was the recession, the dot-com crash.
right.
Well, I'd never seen a recession in my life. I didn't even know what that meant. So when it happened, my business started going down. I was highly leveraged, so I had to make money. I applied at Little Caesars to deliver pizzas. They weren't hiring. So I put my resume out, and the only fools that got a hold of that punk snowboard kid, me, was Wall Street firms. So that's how I got into money. It's kind of out of necessity. I didn't plan on being in Wall Street. I didn't even want to be. Never put a suit on in my life. And even when I went and got the job, I remember like the idea of wearing a suit was so foreign to me
As
that
a
I had to
snowboarder for sure.
yeah, I had to go to Volcom, which is a company I sold in my store, and they sold suits. I ordered a white or a black, a navy, and a gray one, the only 3 colors I could wear, and I had them send me suits so that when I was in the office, at least I had a Volcom suit on, feeling more like myself. It was very difficult, but that's how I entered it, and it was supposed to be a temporary thing, but it ended up being something I fell in love with. I made more money that first year as an advisor than I had ever as a pro snowboarder, and it just kinda steamrolled from there.
Okay, so you do Wall Street, you learn, the behind the scenes of money. What kinda happens from there?
So I was still just doing the snowboarding, still had my shop. So everything was going great. I was killing it. And in 2008, my lease came due. Well, 2007 into '08, my lease came due at one of my main stores. 2 buildings down was a dilapidated paint store. And I looked at it and I said, I can develop that into a 3-unit strip mall and I can move my store in and then I can rent the other 2 and have somebody else pay my mortgage instead of me paying rent. Well, we all know 2008 was the Great Recession. And when I did that, it was just bad timing. I borrowed 370 grand for some from some bad guys that wouldn't have just taken the property back, and that's where everything kind of changed.
Right.
So I almost lost it all, almost went bankrupt. If it wasn't for my girlfriend paying my mortgage, my utilities, and letting me move friends into my house, I don't think I would have made it through that.
Mm,
So that was like a tipping point for me where things got weird because I was making a ton of money in Wall Street. I was doing well. I was like number 3 in the office. But I started to, after that point, I had kind of taken a step back. I almost went bankrupt. So I looked at who wasn't hurt by 2008. And I had some clients that were real estate investors. They barely invested any money with me, which you clearly know why. Real estate's more lucrative than the traditional financial stuff that I was
mhm.
doing. So I started like picking up on maybe I should be in real estate. I'd flipped 2 houses up to this point, but just really terrible job at doing it. So in 2009, I really dove in and I started buying apartment buildings. And I did that from 9 to 14 and I got up to 36 units. But I was not educated. I didn't have mentors. Matter of fact, I wouldn't I the thought of paying somebody to teach me how to do this was such a foreign thing. I was like, why would anyone do that? So I did it and in 14 I ended up losing it all. Had to
Mm.
sell every single one of those properties.
Why do you think it failed? You just
I
weren't
can tell
managing them right?
tell you exactly why. No, no, management was fine. I was borrowing money in my personal name because in my personal name, the mortgage was less
Mhm.
interest than it would have been in my company's name.
Right.
And I didn't know that there was like a limit on that. I didn't understand debt to income ratios or how banks worked. So when I brought the 37th door to this bank, the bank was First Niagara. They said, you don't meet our criteria. We can't approve you for this loan. No big deal. I just said, okay, I won't do that one. But then they came back and they said, hey, listen, because your debt to income ratio is out of whack, we have to freeze your line of credit. I had 2. So one got frozen, then they froze the next one. They took my ability to do the business. I had a bunch of unfinished units that I couldn't get done.
Mm,
I was taking every penny from Wall Street and everything else I was doing, plowing it into real estate. I was just you just hit that point where you're too leveraged. And I think I just had to start just selling them off.
wow.
It sucked. It was bad. I mean, it went quick too. I sold this one and that one and this one, and then it just spiraled out of control. A lot of things happened. One of the mortgages got called, and I didn't know that bank was selling to a large commercial bank, so they were thinning their balance sheet out. But I didn't have a clue. I just thought, wow, they just hate me. So
Yeah.
that's what happened, and I ended up selling every property. I sold our dream house that me and Larissa, who is now my fiance, bought, 171 Radcliffe. I'll never forget that thing. And
Wow.
I even remember like sitting in that bedroom. Larissa was leaving me, and I remember watching the guy from Craigslist come in to take my bedroom set out because I had to sell everything.
Mm, it's
It
crazy.
was a tough time.
Yeah. Yeah. It reminds me of, man, that was probably 14. That's around the time I started buying things on Craigslist, ironically, and flipping couches and stuff. So I might have been the guy, you know,
It
buying
would
your
have been a
bed.
long trip to get the bedroom
Yeah.
set.
But no, I mean, I've seen it. I've seen when I was doing that, like all the people moving in and out and for various reasons. And yeah, but obviously you're at where you're at today. And I know as somebody who's been through a lot of different difficult periods financially and business and everything else, that it's usually those failures that lead to the biggest successes.
100%. But
So, yeah.
when you're in that
Oh,
mist,
oh,
it
it
doesn't
sucks.
feel like that. It
No.
just feels like I suck. I'm a failure. I can do nothing right.
Hmm.
But everything you learn when you're in that mode is the most important thing to catapult you to the next level. Now we
Yeah.
know this now, but back then, I had failed a few times, but I hadn't stopped the blame game. Every time I failed, I blamed everybody else.
Hmm.
Blame this person, blame that business partner, blame the markets.
Hmm.
Never took responsibility for the actions that actually landed me in that circumstance. But at that point, I started to, and the next phase was kind of a very interesting self-discovery and self-development phase.
Yeah. So what happened?
I got a postcard. I remember I sold that house. I'm living in one of the apartment buildings, the only one I had left because I had a partner that didn't want to sell it. And I'm living there. Larissa had moved back in, and a postcard comes in the mail. Come learn how to flip houses. It was Doug Hopkins' postcard. You
Oh,
know
my
Doug.
boy.
You know
There we
Doug. Yeah.
go.
So, and I flipped it over, and on the back, well, I didn't want to go learn how to flip houses. I'd already had a bad experience. And on the back, it said, "Come to this seminar, and we will give you a free iPod Shuffle." They really weren't giving away iPod Shuffles, they were Chinese ones, but Doug, so like
Yep.
that was the ploy. So I got me there because I had nothing to lose, but everything to gain because an iPod Shuffle at that point was important. I went to this 3-day event, and this is where we get into the people that you know. So up on stage, two guys got up there, Mike and Greg, and we're talking
Yep.
Greg Hurling.
Yep.
Mike, I'll leave his last name out, but they got up there, and instead of talking about real estate directly like everybody else, they talked about money. And I
Right.
remember listening because I was the money guy and I was in the back seat, and I'm thinking, all right, what are these guys going to teach me about money that I don't know? But as soon as Greg opened his mouth, everything he talked about was completely foreign to me. As an advisor of at that time, let's call it 13, 14 years, he was talking about things I'd never heard mentioned, never been trained on, never even knew existed. And at the end of him and Mike talking, I remember that he said the ultimate in real estate is being the bank.
Mm.
Dude, they did the call to action. I ran to the back of the room as quick as I could to spend that 2,900
Uh-huh.
to go to the next event, which was the summit. And that's where it all began. And then that led to a $27,000 swipe and 85,000 in total. So like I went from a guy that would never pay for coaching, thought it was the stupidest thing in the world. Why would anyone pay to learn? You can learn this for free in books. To the guy that just went in 85 grand to be mentored, to be coached. Now that whole process wasn't a great, perfect process because the company, but everything you get out of a coaching program, good, bad, or indifferent, is your application of knowledge. And I'll tell you, one thing me and my wife did is apply to every darn thing we learned because I didn't have 27 grand. They actually, well, you remember this, they would teach you how to increase the limit on your card. My card had 5,000 bucks. That was the limit. And they got me to somehow get them to give me 25 grand. And then I swiped it for, 25. And then I had to come up with 2 grand out of pocket. It was everything I had.
Right.
And I didn't know how I was going to pay it back. I freaked. So after that, it wasn't just like, 27 grand. It was like, we have to pay that back in 6 months. No ifs, ands, or buts.
Right.
So we hit it hard.
Right.
Real hard.
So
That started
you
the next
you went on the
phase.
real estate trail, and would you end up flipping houses?
We were just flipping. Because remember, I just lost
Yeah.
everything.
You're like, I don't
with
like
rentals.
apartments anymore.
I was scarred from it. So I
Yeah.
just was like, flip, quick money. Let's do this. And, I was watching the TV shows. The first one I ever saw was Doug's show.
Yep.
And I was just watching those. And that's what got me excited. But at a summit, me and Larissa were in the front row because now we were students, right? Now we're like, teach me. We always sat in the front. Tark and Christina get on the stage. And I remember I was starstruck partly. And the other part was I come from the snowboard world where we were always filming for video parts. I looked over to Larissa and I said, Larissa, if I'm ever going to be on that stage, or I think I said, if we're ever going to be on that stage, we got to have a show. So right then and there, I created this idea for a show. It was going to be Flip or Flop meets Jackass. And I came home. The guy that worked in my shops, his name was Kyle. He did a video production. I said, I'm going to hire you. We had a beer and we put it all together. He was going to make the sizzle reels and the pilot. And we began. The property was 665 Hopkins Road that we made that first sizzle on. I thought it was a masterpiece. My skateboard team from the shops came in and they demoed things. They made ramps. And they were skating on the ramps in the demoed house. And then we flipped it at the end. And I think we made like 45 grand on that one. So that was like the first pilot, or not pilot, but like sizzle reel. HGTV hated it. A&E said this is way outside of our scope. And we were with a producer who loved the idea out of Toronto. But then after that, nothing panned out. So we ended up getting another producer that was, brought to us by Mike, who had a show on A&E. And then they said, here's the box of what HGTV wants. We have to fit in this box. So just show me the way. So all that fun skateboards, stuff went out the window, and we made a show that was edgy, but in their box. And we made it all the way. We piloted, we launched, we were number 2 out of Greenlight. Dude, I burned the boats. I literally went so deep into this. We were flipping 20 houses a month. It was insanity. And I was so tuned out of Wall Street at this point. I knew I was on my way to the exit, but it was just easy money because I had a big book. And I remember when we got greenlit for the show, I had to get an OBA, which is an outside business activity. And I went into my compliance officer. I said, hey, we got our show, thinking she'd be excited. And she says, oh, okay, congratulations. I said, I need to get an OBA for this HGTV show. She just looked at me and she said, that's not going to happen. You got to decide, Chris, if you're going to be a financial advisor or a TV show star.
Yeah, you're like, I'm going to be a star.
See ya. Hey, Mike, who's the guy next to me? You want to buy my practice? We worked a deal out, which worked out, and he still pays me checks today. And boom, dude, boats burned.
Nice.
Until that night.
That's awesome.
Yeah.
So you do the show. What happens from there?
So doing the show, trying to figure out, I didn't really have a plan B, so to say. I had the show. It was going to work. And one night, after our show aired, and I remember pivotal moment, Tarek and Christina were airing, we were right after them. And I remember our ratings came out, they were solid. So I'm like, we got the show. Just in your mind, you just believe you're going to get it. Driving home one night from a flip, phone rings, it's our producer. I pick it up so excited, but the voice on the other end wasn't excited like I was. And he's like, hey, I got some bad news. They're not moving you on to series. Discovery bought HGTV. Our whole team that was rooting for us now got displaced, and Discovery wasn't putting any new shows. Ryan, I got to tell you, and I say this I don't say it very often, but that was that moment where literally I contemplated just taking the wheel and just jerking it to the right. See what happened, because I just didn't know how I was going to tell my wife. But I ended up going home, told my wife, bawling, just not knowing what's next, and my phone rings. I pick it up, and it's Greg Hurley. I'm like, hey, Greg, what's going on? He's like, oh, I'm so happy for the things we're doing. This is when we were doing our funds. So happy for the things we're doing. I'm really excited. Greg's usually a pretty upbeat kind of guy. And I'm like, who told you? Thinking somebody tipped him off. Somebody told him, because he had a lot riding on the show as well. And he's like, told me what? I'm like, you're not just calling me out of the blue to tell me how excited somebody told you you're trying to cheer me up. He says, no, I'm just excited for what we're doing. A lot of big things coming. I'm just pumped. I said, I didn't get to show. So in my mind, I was so down that I thought, just because I didn't get the show, now all these people that I thought were with me were going to just run and just be like, has been. But that wasn't the case. He's a partner today, or a dear friend of mine. And, so that door closed, and it opened the next door, which is everything that I do today.
So, dude, first off, amazing story. I love getting into how people got to where they are today. I think it's super important for people listening who, obviously are going through at what point of your story, and I can tell you, those are the things that really help people get through those positions and just really see what's next. And so I've shared a lot of my stories of, things we went through to finally get to where we're at today. And, I go through things today, that are not easy, that I know that, hey, you know what, this is temporary. I'm going to get out of this. It's going to lead to something better, and it's going to be great. So props to you for sharing that.
Thanks, man.
Now, let's talk about this whole money thing, right? You've got a few different companies. You've got, actually, I'll let you name them because you got a few, but
there's a lot of them, but we'll just hit the big ones. The Money Multiplier, which is the sole general agency that does the infinite banking concept. That's the only thing we do there. I got Money School, which is an events company. So Money School feeds, the events, the marketing, and everything else. It's basically just a marketing company for Money Multiplier and the other companies, and the sole operating company of everything. And then we've got Private Money Club, and then all of our real estate holdings. We also have a private hedge fund, but those are the main companies: Money Multiplier, Private Money Club, and Money School.
Yeah, I want to talk about Private Money Club later because that one's really interesting. What you guys are doing with software and connecting, these lenders with potential borrowers. But I want to talk about infinite banking right now. So with your money multiplier, a lot of people have a negative connotation of whole life or infinite banking and all that stuff, myself included. Every time I've ever been pitched it, I'm always like, this doesn't even make sense. Why would I want to do this? And before we got on show, you started telling me about ways that you're doing it differently and why it actually does make sense in some situations if, your guy actually giving you the policy is building it in a way that makes sense. So, for those who have no idea what I'm talking about, like let's first break down what whole life is and what this whole infinite banking thing is.
Okay, so what is whole life? It's a life insurance policy that lasts your whole life. That's the simplest thing. It is an expensive, overpriced life insurance policy that is sold by advisors because it pays a big commission. Did I accurately describe that the way that you used to view it?
Yes.
Okay, well, that's how I used to view it. Exactly. As an advisor, listen, I made money managing assets. I sold term and invested the difference. So the day when I was out in Salt Lake City meeting with Mike about borrowing money from one of my deals, and I just asked him, I said, so Mike, how do you lend? I thought I had an idea, and he says, I have my own bank. I'm like, you dirty dog, you got a bank? And I'm like, let's go. And he's like, no, I created a banking system. This guy did it. And long story short, he tells me what it is. He says, it's a whole life policy. I sat back and I'm like, man. And I felt weird because this guy's got way more money than me and incredibly successful. And I'm like, I said to him, I said, Mike, somebody told you a lie, man. Whole life doesn't work that way. You can't put money in a whole life and immediately take that money out. I've never seen one that works that way. I've never been taught that. So it just doesn't work that way. And he leans into me and he says, Chris, if it doesn't work that way, how have I been doing this over and over and over again? And I said, well, okay, what don't I know here? So he turned me on to the guy, and then I watched a 90-minute video, which is where everything changed. So infinite banking, okay? A lot of people think infinite banking concept is a product. They want to say infinite banking, whole life, infinite banking, whole life. And I understand why it's that way. The pioneer, R. Nelson Nash, the late R. Nelson Nash, in his book, Becoming Your Own Banker, talks about a whole life as the machine that moves money for the infinite banking concept. But infinite banking concept is a process. Think of banking. All infinite banking concept is the same thing a bank does every day. So why would we use this stupid, overpriced, terrible vehicle that Dave Ramsey, Susie Orman, and everybody else says is the worst place you can put your money? It comes down to how it's built. See, I didn't know you could take a whole life, pull it apart and reconfigure it the same way. The easiest way I can explain this, Ryan, is you know who Ken Block is?
No, I don't.
Rallycross driver, okay? One of the best in the world. He drives a Ford Focus. That's his rally car. So let's say I get, I want a Ford Focus because I watched one of his videos. I go to the Ford dealership. I'm on the floor and I'm looking at a Ford. You're laughing. I'm looking at a Ford Focus. My wife's behind me. I'm like, honey, that's the one. That's the car I want. She looks at me and she said, crazy people will not take you seriously.
This car
talk
sucks.
about money. That's the one. And then I don't get it. But then I'm home and I'm watching his video. He's going 130 miles an hour sideways around a turn in full control in none other than a Ford Focus.
Mm-hmm.
What's the difference between the one on the showroom floor and the one that goes 130 in full control sideways?
He's modified it.
Engineering.
Yeah.
So these whole life contracts, they can be engineered. And they have been for hundreds of years. The Rockefellers, the Rothschilds, the Walt Disneys, the Ray Krocs, the Joe Bidens, not to get into the politics side, but that is heavily used there. They've all used this for hundreds of years. But we don't know about it, and here's why. As an advisor, I sold whole life if I did because it was a big old fat commission. Same reason people sell IULs, big old fat commission. But I never knew I could actually build the contract to pay out a really, really low commission. And if I did that, my client had access to more money. That's what this is about. It's re-engineering a whole life contract with a special company, a mutually owned company that pays dividends to work for this. It works just like a bank account.
Mm-hmm.
So that's what we do. The whole life should never be used as a place to put money and just leave that money there.
Mm-hmm.
If that's the case, please don't call me. What we teach is that's a machine. We put the money in it and we immediately take the money out.
Right.
Everything I teach involves changing just one thing, and that's where your money goes first. Not all your money, just the money you would save. Most
Right.
people say, we talked about retirement accounts. Most people would save money in a 401k or a savings account, or commonly the savings for people is, okay, I made this much and I spent this much. The rest is, well, I guess how much I save, and it sits in a bank account.
Mm-hmm.
Who's winning that game?
The bank.
Absolutely. Because the bank is taking the money they've convinced you to give up control of and sending it out to work for them. They lend that money out. They pay you 1 and they charge me 5 for the loan. They make a 4-point spread in between. And they didn't have to take on very much risk. They didn't really have to do anything other than know how money works. So when I saw this, I started compiling this whole idea of, I just want to be the bank. I just want to mimic what a bank does. The machine, which is the whole life, specially designed and engineered, allows me to put money in it and immediately in the next 30 days, take that money out. Maybe not all of it in the first year, but up to 90%. Take that money out and then do stuff with it.
Mm-hmm.
So that's really how this works. But to go one step further, it's not the policy you should be excited about. But the policy does some things, and the reason we use a whole life, it does some things no other vehicle on earth can do. And let me just pull out some money here. I want to do this with a visual because it's just easier for me.
All right.
Everybody saves money or says they are or wants to. So when you save money, imagine you use a bank account. We talked about this earlier. Why wouldn't I just keep it in the bank? You could. The bank's going to pay you 1% or less. But the cool thing about a bank account is if you need this $100 to do a real estate deal, you have liquidity to take that money and move it. So what if all I did is I took that 100 and I just changed one thing, and I just changed where that money went first. Instead of putting it in somebody else's bank that's going to make it work for them, I put it in my bank. Why would I do that? I would do it because my bank pays me up to 6%. The average policy we write is between 5.2 and 6% with dividends. So 1 versus 6 is all of a sudden better. So I'm making 6%. But now I'm worried because that money, that 100 I just put in there, I can't take out. But what if I could immediately in the first 30 days or even sooner? When my check clears, that money's available. So I go in and then I take out. Now I'm not going to cut the bill in half, but let's say you come to me and you got a deal and you want $9,000. Let's just pretend this 100's 10,000. So then I take a loan from my policy for $9,000. I give you $9,000. I started with 10. It's making 6%. I give you 9. How much is left in my policy?
Still 10, right?
Right. But most people would say 10 minus 9, you got $1,000 left because they're doing the math like a bank account.
Yeah.
I have 10 grand left in my policy because that 9 grand I just gave you wasn't my money.
A loan.
It's a loan from the insurance company. And the insurance company gave me a loan that never needed to be paid back because that 9 grand wasn't the insurance company's. It's their money, but it's money they promised to me. But to get that 9 grand, I have to die because that's the other promise the insurance company makes is I got to die to get the death benefit. Well, I don't get it. Somebody else does. So the insurance company will give me part of my death benefit up to the amount of cash value I have, which is 10 grand as a loan. But that's a swear word already. Some of the people, and I think when I told you, you're like, yeah, but it's a loan. Like there's a cost to the loan. Of course, they're paying you for 6, and the loan cost by today's numbers is 4%. So 6 minus 4 is a spread of 2. Remember I said how a bank worked? 1 and then 5. They make a 4-point spread. I just made a 2-point spread. Nothing changed. But now one cool thing. The 10 grand's still in that account. The 10 grand's still earning interest and dividends. And the 10 grand will continue to compound for the rest of my life, no matter how many times I put money in it and take money out, put money in and take it out. And that spread every year, it was 2 the first year. The next year, it's more. The next year, it's more. Because people they think they understand compound interest, but they don't truly understand what Albert Einstein called the 8th wonder of the world. Money that earns interest can then earn money on the interest it earned and on the interest it earned and just compound over and over and over. And it doesn't stop. And it doesn't take any work. It doesn't take anything. It just takes time.
Right.
How'd I get the name Mr. Brrrr? It's
Yeah.
actually my name, Devin Brrrr. It's
Yep.
not spelt the same, so it's Burr. And I was doing real estate investing. I did wholesaling, flipping, early 2020. No marketing dollars. I was just going to meetups and local events and
Yep.
JVing deals. And then I noticed I'm making some pretty good money because I'm not spending it for marketing, right? But I'm paying a lot of taxes. I know how taxes work. Like I was capital gains, right? Short-term capital gains.
Yeah.
So I'm thinking, how can I become more wealthy? And it's by holding on to properties, right? So I knew there was the method, the Brrrr method. And I'm like, I am Devin Brrrr. How about I be Mr. Brrrr? Because that's who I am.
Yeah.
I just coined myself as it. I started making shirts. I made a necklace.
You got the chain.
I got on my all my coats. I do the embroidering so I can write them off.
You got it right there?
Yes. So this is Mr. Brrrr. Oh, it's on this side.
Oh, that looks good.
Made for Mr. Brrrr.
I like that.
So yeah, just started just coining myself as that guy, and
Yeah.
was getting deals sent to me. And again, no marketing dollars. So was able to keep a lot more of the money and build wealth pretty quickly in 3 years.
Yeah. So today, I mean, obviously you guys have done real estate stuff, but really where you've kind of made your money the last 3 years is through insurance, and more specifically whole life insurance, where you've sold the third most policies in the nation in
Yeah,
just
it's
the last
crazy.
3 years.
Crazy.
How do you do that? Like out of nowhere? Like how does one become the third biggest whole life guy in just 3 years?
The power of this thing.
Yeah.
This is, everyone looks at this at all times. They're attached to it all the time, right? That's where attention's at. So I figured I need to go where attention is, which is social media. It's a free platform. So I just started putting out content about infinite banking and what I do and how I use money and how I build wealth through whole life policies. And it's, whenever I say whole life, people are like, ugh, that's a bad word. It's not your normal whole life. We lower the death benefit, so you're paying very little cost, and then you overfund that actual policy to get cash value.
Yeah.
And all that cash value is protected by the contract, which states grows tax free, protected against lawsuits and judgments. And then, by the way, we all die at some point. It also gives a death benefit.
Yeah.
And then it grows at 3.25 guaranteed minimum plus dividends. So it's a better place to store money. I just started talking about that and grew a following really quickly. Within, I'd say 2 months, I had like 300,000 on TikTok.
Wow. Just talking about infinite
about
banking, whole life.
Yeah. How it works, how I use it with real estate. And then everyone just started asking how to get it. They're like, I want one. So I'm like, at first I was just sending it to the person that I got mine from.
Yeah.
No inclination to like monetize it. I'm just like, yeah, go to Chris Noggle. That's where I got mine. Go to Chris Noggle. Go to Chris Noggle.
Chris has been on the show.
Yeah. And I sent him legit probably like 100 to 150 pieces of business in like 3 or 4, maybe a week. And then
Really?
it hit me. I was like, wait, this is stupid. Like,
Why am I not doing this?
right. So I hit him up. I was in my backyard. I'll never forget this. I'm like, hey, Chris, got like 30 more people for you. But quick question, just out of curiosity, is there a way maybe we could both benefit from this whole situation I got going on? He's like, yeah, just get licensed and you set the policy up. My team will take care of the rest and you'll cut me off with a little percentage. You keep the rest of it. So that's how I've built it so fast, is just a lot of eyeballs looking at it. They go down a funnel. They get on a call with me at first. And then I just don't want to take the calls anymore. So I just hand them off to the team.
Yep.
I give up a little bit more of the commission, but I still keep the lion's share because I'm bringing in the lead,
Yeah. It's your business.
you know?
So a lot of people, like you mentioned, they hear whole life and they're like, oh man, like this sucks. This is a scam. Like it has a very negative connotation. And, you know, whole life isn't the only one that does. I mean, there's so many things I think that do, you know, whether it be wholesaling has a negative connotation to a lot of people. Realtors have
Yes.
negative connotation. You know, MLMs and like, you know, whenever people talk about, because like even in the insurance industry, like I've interviewed, you know, these big guys where their whole business is built on, you know, downlines. And so people don't really like those kinds of businesses. And I'm like, at the end of the day, the more I've been in business, the more I've realized I'm like, look, if you're ethically making money, I don't really give a crap how you did it. Like at the end of the day, whether you do a real job or a real career, as some people would call it, like, I don't even know what that means, but you know, people are like, oh, you know, this guy's a guru. All he does is make money in education. I'm just like, I don't give a crap how anyone makes money. As long as they're doing it ethically, I'm good.
Yeah. As long as you're not stealing from somebody else to have yours.
Yeah.
Absolutely.
Yeah.
You know, and it's funny because I actually used to get that same response when I started off wholesaling.
Yeah.
I'd be doing text campaigns and they'd be like, why don't you get a real job?
Exactly.
I'm like, what does that mean?
Exactly.
I used to have
They want you to be a busser.
Yeah.
That's a real job. And it's true though, because it's funny. I started out as a house flipper and I didn't think anything of it. It was fine. And eventually I realized like wholesalers and house flippers kind of like had this thing where wholesalers weren't really real estate investors because they weren't actually buying properties or doing anything. And house flippers and multifamily guys and landlords, like they're the real estate investors. I'm like, all right, whatever. Then, I get on social media and we start doing education. And then I realized that, gurus have this big stigma of, oh, these guys are making more money selling education than they are in their business. Like that's wrong. And I'm like, is it? I mean, it seems a lot more scalable than flipping. I'm already flipping 100 homes a year. Trying to go flip 1,000 homes is really hard. Trying to go get 1,000 students is way easier, and I can actually help more people. So why wouldn't I just do that?
You hit it right there. It's helping more people. You're helping people with scale. So if you flip a house, you're helping a family, right?
Or just yourself and your employees, and that it just kind of stops there.
Right.
Yeah.
But if you have a course and 1,000 people do the course, if they all take the action, they'll do well.
Yeah.
Right.
You just changed 1,000 families' lives.
Yeah. So you're helping people at scale. The more people you help, the more money you make.
Yep.
And that's what I started realizing with when I got into infinite banking and everything, and I was talking about all these things that were helping me become more wealthy. That's all I was doing. I was not trying to monetize it. I was just trying to help. It's helped me. It's going to help somebody else. I barely graduated high school.
Yep.
Like barely I read one book up until I was 31 years old, ever.
What book?
It was Catcher in the Rye.
I thought you were going to be like, I can't remember the name. I was like, you didn't even read one, did you?
It was Catcher in the Rye. It was like a school book.
Yeah.
And generally in school, I used to turn to the back of the book, read that, and do the book report off that.
Yeah.
But for some reason, Catcher in the Rye, like it hooked me. And I read that book in high school.
I would just read the Spark Notes.
See?
Yeah.
There you go.
Yeah.
So I figured if I could do this, anyone could do it. So I just started sharing. And then money just started following me.
Yeah.
I didn't have to go chase money anymore, which was nuts.
Yeah. You learn the power of generating leads.
Right.
Because at the end of the day, right, you figured out how to get attention on social media, and then you started to see what people were resonating with, and you're like, all right, well, I'm generating all this business. Like, how do I make a business with all of this, these leads I'm generating?
Right.
And that's kind of how I've always operated too. It's like, I'll put out a ton of stuff on social media of just like stuff I'm doing, just like you. It's like, yo, I got this infinite banking thing going on. It's cool. It's just what I do.
Yeah.
And then all of a sudden people are like, dude, I want one. That's what's happening with me right now and peptides and stuff. I'm like, yeah, I've just been doing it for like 3 months. They're like, dude, where do I get it? And I'm like, dude, am I going to have to
So now you need an affiliate with the peptide guy.
No, I don't. I literally don't have anything, but I'm just like, do I have to start the peptide business now because everyone wants it?
See, you're more of like a serial entrepreneur. You start actual businesses around everything. Me, I just want the affiliate.
Yeah.
That's all. So that's what I started doing is when I had this following, I noticed that people that would do infinite banking, if they have a business, an LLC, an S Corp, whatever, it makes more sense because you can then lend to that business.
Yeah.
So you become the hard money lender for your business instead of your business getting it from somewhere else.
Yeah.
If your business was going to pay someone else interest, why don't they just pay you interest?
Yeah.
Right?
Yep.
So it makes sense to have an LLC. So what I started doing is noticing people needed LLCs. So I got an affiliate with a company that sets the LLCs up. Mm-hmm. You know what I mean?
Yep.
People needed estate planning.
Got an affiliate
for that.
Yep.
Credit repair, affiliate for that. So I don't want to start all the businesses. You know what I mean?
I'm the opposite. I don't know why I put myself through it, but I just like it.
I mean, it's a game to a certain extent, right?
Yeah.
It's a game. So the game can be very, very fun, right? That's why you do it.
Yeah.
You don't do it for any other reason. You've got more than enough money.
Yeah.
Right? You don't need more when you get to a certain point. Mm-hmm. You do it for the fun of the game.
Yeah.
So
100%. So let's talk about this infinite banking and whole life and everything. So you were already doing it when you started talking about it on social media. People have probably heard about it, but they still don't understand it. And even after talking to guys like Chris and others, I still am like, I kind of get it, but I don't fully get it.
yeah.
What is it?
Dude, I think the biggest reason is because it's such a different concept. No one thinks to flow money through a life insurance contract.
Yeah.
Right? So as soon as you hear life insurance, what do you think of?
Well, I mean, like I have a term life insurance, so I just think like, yeah, I mean, when I die, then There's life insurance for that.
Yeah. So you think the benefit is the death benefit?
Yeah, yeah.
That's what people think of. They think life insurance is a death benefit. It's called life insurance, not death insurance, right? So if it's structured properly, it should be used and can be used while you're alive.
Okay.
Because it's got living benefits if structured properly. So basically what infinite banking is, I'll try to keep it as super simple as I can. It's just mimicking what banks do with money. Think about when you put money in a bank, do they hold it there or do they lend it out to other people?
They lend it.
As many times as they can, right? Because a deposit to them is a liability. They have to pay you in order for you to keep the money on deposit, right? So money's leaving their pocket. How do they turn that into an asset? They lend it. So they make loans an asset. So if they pay you 1%, but they lent it at 4%, what are they making?
Yeah. I wish they would lend it at 4 these days.
Right.
But they don't.
So they're just making an arbitrage on money, on our money. So infinite banking is just taking back that function. So instead of the bank doing it, you put your money in a properly structured policy. Now you're getting the compound interest and you turn loans into assets. So you borrow against this money. It's it's a pot of money that's collateral.
Okay.
To borrow from your future death benefit.
Okay.
Because they know you're going to die someday. If you never pay back your loan, they'll take the collateral and lower your death benefit.
Right.
So
they can't lose.
Yeah, they can never lose. They'll get it back in a day or in 80 years when you pass away, right? So it's an unstructured loan. You're borrowing from your money as the collateral. There's no structure to the loan. You decide when it's paid back or if it's paid back and how much is paid back, right? So again, you're just mimicking the bank. You put your money here, borrow against it. You're turning a loan into an asset. So you're borrowing, let's say at 5%.
Okay.
From your future death benefit.
Okay.
So now that you're controlling that money for 5%, however much you can make above and beyond that, you're keeping as a spread, just like the bank does. And the more times you can do that and the more you flow it back to the policy, the bigger the policy gets because you're flowing more money back to it that you would have, let's say, otherwise lost to the bank, right? Think about if you buy a car. You buy a car, you get a loan, you pay the bank interest, right?
Yep.
Every month on time because you don't want your credit to go bad.
Right.
But if you borrow from your policy, can't you just pay yourself that exact same payment? Now you're getting the interest the bank would have got, or you're doing an investment where you're keeping that spread and that money's going back to the policy. So it's just a place to mimic what banks do with money. That's it.
So if I'm hearing this correctly, all you're really saying is that instead of putting your money with the bank, just put it in a life insurance policy.
Properly structured.
And the benefit is, okay, if I put it with the bank, I'm going to get no return because they're just not going to pay me. But if I put it in a life insurance policy, I'm going to get a return, which we haven't really talked about how that works, but I'm going to get some kind of return. So for me, I guess what I'm trying to understand is why would I put it in a life insurance policy versus, say, just stocks or a mutual fund or something? Great
question. Few reasons.
Okay.
Insurance companies, they don't lose money. Think about what they do is they evaluate risk. That's all they do. So when you put money in a policy, when I put money in a policy, when your neighbor does, it goes into this big pot of money, billions and billions and billions of dollars. And they just invest the money into super, super sound investments because they're hedging risk all the time. So they're always profitable through Great Depression, World War I, World War II, meltdown of '08, COVID. Like you can look up these companies, profitable for like 140 consecutive years. Crazy.
That is
so
crazy.
Like, think about the stock market. If you're up 50% and then you're down 50%, you have an average return of what would be zero, right? But your actual return is less, right? If you have $50,000 and you go up by 50%, what do you have? 75 grand, right? I'm trying to do the math quick. I don't have my calculator,
right.
but then if you lose 50% off 75 grand, now you're at what, 37.5?
Yeah.
Your actual return is negative. But everyone looks at like the stock market and mutual funds. Oh, at average 8%. What's the actual? And the actual is actually around 3%. Actual returns in stock market. I think over the last 25 years.
Really?
Actual returns. Crazy. So one, you get a better return actually in a policy because it's also tax-free. So if you make 8% average and then you're taxed, you're not keeping 8%, right? In a policy, let's say you make 5 to 6, it's tax-free. So that's like you're making like 8 to 9 before taxes, right? So that's one reason. Second reason is, let's say you put money into a stock, and if you can borrow against it, I don't even know if you can borrow against stocks.
You could borrow against your portfolio or like a money market, something like that.
Okay. So let's say you do that.
Yeah.
There's no guarantee that money that's accumulating in the stock is going to go up. Like I just said, it could go down.
Yeah.
In a policy, it's guaranteed to do one thing and one thing only, go up. So you always have a bigger pot of money to borrow against.
Got it. So it's safer.
And it never stops the compounding because you're not taking it, you're borrowing against it.
Okay.
You know what I mean? And then you pass away, your family gets a multiple of whatever you had put in there. That doesn't happen with stocks.
Right.
Also, it's protected against lawsuits and judgments. Stocks aren't, right? So it's a safer place. It's with companies that don't go under, that aren't insolvent like banks are. One of the insurance companies we use, 169 years in business. Like,
why do you think all these banks went bankrupt the last year? It's kind of crazy.
I mean, who knows? There's always, I think there's someone pulling some strings, right?
It's like the Silicon Valley Bank was this massive bank, been around for decades, and then just one day, they're just toast.
Here's what I think.
Okay.
And like, this could be accurate, could not, is there's this thing called fractional reserve banking.
Yeah.
So you put money in the bank, they only have to keep a fraction of it on reserves. They can lend out the rest, right? So let's say that there's all these deposits in the bank. They've got it all lent out into investments, and those investments dropped in value. And now people are starting to want their money. They go to the bank. It's called a run on a bank.
Yep.
They go try to get their deposits out. The bank doesn't have it. So they have to sell off assets, and now they're selling off assets at a loss, right? So that's how I think they went under, is they're selling off assets at a loss to pay us back our deposits that they didn't have because they lent them out. Cool thing about life insurance, you put money in a policy, it goes into their general funds. They can only lend out what's in that general funds.
Really?
They cannot do fractional reserve.
Got it. So they're always lending what they got.
So they're never insolvent. And again, they just calculate risks. So they don't go buy Dogecoin, you know?
Yeah.
Like they're doing like long-term treasury bonds. They'll lend blocks of money to hedge funds or banks. So they're just doing really calculated investments, and then they don't insure everybody. If someone's about to die, they're not going to insure them because then they'll have to pay out a death benefit.
Right. They're only paying, or that's the crazy thing about insurance is like the young people pay way too much for what their true risk is because they're kind of subsidizing the older people.
Yeah, 100%.
Yeah.
But you think about this, though, the most common insurance policy is a term insurance.
That's what
you have.
Yeah.
When did you get it? How old?
Man, I was probably late 20s when I started making money.
And it's probably what, 20-year term?
Dude, I have no idea.
It's probably 20
I haven't
years.
looked at it in years.
So
they made me get a blood test and all that stuff. I had to do a physical.
It's probably going to expire when you're like late 40s.
Okay.
They know without a shadow of a doubt, by statistics, the likelihood you are going to die in that time frame. You're healthy, you work out, you don't live some crazy lifestyle jumping off mountains or something.
Now I'm on peptides.
Now you're on peptides.
It's like, who knows?
Let's go.
Who knows?
So they know you're not going to die.
Yeah.
You're going to outlive that contract. They didn't have to pay anything out, and you paid them for 20 years. Now, if you want to get that exact same coverage at 49, you're more likely to die in the next 20 years. So your cost goes up like crazy.
Got it.
They know that. But then even then, your likelihood of dying before like you're like 70,
still low.
Slim. So they know that. But then when you hit like 70 and you want that same exact coverage, you can't afford it anymore.
Yeah, they're like, nah, dude.
This is why they're so profitable, because they advertise term insurance because it's the most profitable. If you only have to pay it out 1% of the time, 99% of the time, you get those payments like clockwork every year, every month. Of course, it's going to be profitable. You know what I mean? So I think that's another reason why a lot of people, they don't know about infinite banking. I think everyone should know about it,
Yeah.
but they don't know about it because it's not the most profitable for the insurance company. And not the most profitable for the agent either. The agent makes a lot less money.
So why do you always hear that agents make so much money like with whole life?
Regular whole life, agents make a ton of money.
Yeah.
So think of it like this. There's two parts to a life insurance contract. There's a base premium. That's like regular whole life. That pays for a death benefit. Okay. What we're doing is we're lowering that. So we're essentially lowering the death benefit.
Okay.
We're not highlighting the death benefit.
So that, you're not going to get paid as much when you die compared to.
Yes and no. So I'll get to that.
Okay.
So the death benefit gets lowered. And then that way you don't have as much costs, as much fees, as much commissions.
Mm-hmm.
And then what we're doing is we're having you overfund that base premium with paid up additions. It's basically like prepaying for insurance that doesn't have a cost.
Okay.
So you get a little bit more life insurance, but you get a bunch of cash value.
Okay.
And that's what you can use for whatever you want. The way it's structured is when the companies are profitable, which again, these companies are profitable every freaking year, they pay a dividend. And that dividend buys more paid up insurance. So you're essentially always getting an ever increasing cash value and an ever increasing death benefit. So like I've got a policy where I put in 125 a year. The death benefit, if it was regular whole life, 125 grand a year, the death benefit would be like 80 mil.
Got it.
It started off at 7.6. By the time I'm likely to die, it's up over the 80 mil. It's at like 156 mil. Because ever increasing cash value, you have to have an ever increasing death benefit to match it, or it's not a life insurance contract. And then it becomes taxable. So that's why it's important working with like our team is we know how to structure them to make sure they're done right. And so they don't become taxable.
Got it. So to me, what I'm hearing is by doing whole life, you get the benefit, obviously, the death benefit.
Yep.
You can borrow against it. And your, I guess, it's got a guaranteed, rate at which it's going to pay you versus a stock or something which does not.
Yep.
How does it get a guaranteed rate?
Because the insurance company just knows without a doubt they can make at least 3.25% interest.
Okay.
Because remember, you're putting all your money there and it goes into their general funds. They know they can take it and go make 5, 6, 7% like clockwork. And then also they earmark how much is going to be paid out in death claims. So like, let's say they earmark $2 billion for death claims, but they only had to pay out 1.5. That extra 500 mil is profit. So they distribute it in dividends to their policyholders. So they're just, life insurance companies are just super smart. They know how to make money over an extended period of time. They do not lose money.
What does Warren Buffett do?
He has he owns a corporate owned company. So think of like there's corporate owned and there's mutually owned.
Okay.
So corporate owned has like basically stockholders, right? So people at a round table, they're benefiting from all the moves that the insurance company's making, right? Mutually owned, you buy a policy, you're a mutual owner. You're a part owner of the business.
Okay.
So me, as I've got 3 policies with 3 different companies, I am a part owner of all those companies. So what are all their decisions made for? Me, my benefit. When they make profits, who gets them? Me. I get the dividends because I'm a part owner.
Yeah.
His company is corporate owned. So like basically any profits, they get divided up with the shareholders,
Yeah.
not the policyholders.
Right. So his stockholders get the dividends
Right.
who own into Berkshire Hathaway.
Right.
But if you have an insurance policy with Berkshire Hathaway, it has nothing to do with like Berkshire Hathaway's success.
Correct.
Got it.
Correct. So if they're profitable,
You don't care all you care about is your insurance.
yeah. And
Yeah.
they don't share the profits with you. So why would you care about if they're profitable? You just want your death benefit.
Right.
That's it.
Now, when you do whole life, the death benefit never goes away, no matter how old you are.
As long as you just keep premiums going in. So as long as you keep paying your premiums, death benefit until the day you die. Or if you outlive it, they'll just pay out the death benefit while you're alive.
Oh, really?
I fully plan on doing that. We talked about that on the way up. AI and like our level of income, like I'm going to live to be 150. It's happening.
I keep seeing all these guys say that.
Dude, I'm convinced, bro. 100% convinced.
Why?
Have you like really dove into AI and just how freaking smart it is? It's going to figure some things out if it hasn't already.
Yeah, it's going to make you live to 150 before it kills you. Or, yeah.
It's either going to kill you or you're going to help. It's going to help you live to be 150.
Yeah, I don't think there's an in between.
Yeah. I mean, it's true.
Terminators coming to get you.
Yeah, I'm scared about that, but we'll see. It's all about the input, right?
Either I'm living to 150 or I'm going to die in the next 20 years because of the onslaught from AI.
The robots coming after me.
Yeah.
All the movies that have been throughout the years, right? Terminator, iRobot. Like,
iRobot was a good movie.
It was. I like Will Smith, dude. I think he's a really good actor.
Yeah, he's having a tough time right now with Jada just trashing him everywhere. But
I never follow the news. I don't even scroll on social media. Like I'll be on my phone for like 8 hours on social media, and she's like, what are you doing? And I'm like, I'm working.
Yeah.
I don't scroll. So
the only reason I know is because she's been on like my friend's podcast and stuff. And so I'm like, what the heck is she? Oh, she's promoting a book. Oh, she's just trashing Will Smith to make some money. Okay.
Crazy.
I'm like, this is crazy.
Jesus.
Yeah.
And they had like the best relationship ever back in the day, from what I remember.
I don't know what to believe. As with anything in social media, I don't know what to believe anymore.
This is true. This is very true.
You walked in my office and you thought you were coming to a house. You're like, I don't know what to believe. I thought he had an office and some employees, but apparently this GPS is taking me to a house.
Oh, true story. Everyone watching and listening is I put in the address and it was like literally just a 2-story house and then a neighborhood. I'm like, I think I've seen his house on some of his like content.
This doesn't
look like it. It's a nice house, but like it's not as nice as the one was on there. Like, so I hit up your guy. I'm like, Jonathan, is this a house?
Does he rent that house? Is that in the metaverse? Where's his real house? So
good.
You back to the insurance, because I still truly want to understand this. So like, I have a term policy, which is cheap. I pay monthly. I don't even know what it is. But when I originally got it, it was like a few $100 a month. It was nothing crazy.
Yeah.
And originally when I did it, this was back in 2018. So that was like when I became a millionaire and I set up like all this crap. I got a trust and started having actual assets to protect. So, went down that rabbit hole. And they were like, yeah, you should get a life insurance policy. And so I had a bunch of people pitch me on just different policies. And then like, infinite banking was one of them. And I just was like, dude, honestly, it sounds like legit, but I'm just so focused on real estate. I'm not going to deal with this. I just don't have time for it.
Yeah.
And I ended up getting a term policy because I was like, all right, but if I do die, then let's make sure that my family's got something. And it was for like a couple $1,000,000. And then as time went on, I just upped it to, I don't even know I'm pretty sure it's like an 8-figure term policy just in case something happens. And I've just always kept it because I'm just like, look, I'm going to just go make my money doing all this other stuff. That being said, since then, especially on the podcast and everything else, like I've had Chris and, we've had other people, I don't know on the podcast, but like I have buddies now who definitely that's their core business with infinite banking. And I've read the books too. And I understand the concept of borrowing the money and everything else. What I guess I just don't understand is this concept of why do you need it if, like, let's just say you have cash in the bank. You don't need to borrow from yourself because you just have it in the bank, and so you would just use it. So what am I missing?
I love it. So this is what a lot of people ask the same question when I talk to people. And generally, like, I always know when the light bulb goes off, and it hasn't happened yet for you. So like, this is probably going to happen here is think about if you use that money in the bank.
Uh-huh.
You know what opportunity cost is.
Correct.
Right? If you use that money, you've lost that money's ability to do anything else. Right? It could make you a return, which you know how to make money. So you're good at making returns. So you're not going to lose money per se.
Yeah.
But it's only doing one thing, right?
Yeah.
If it's sitting in a policy, it's now doing two things. Your money's running parallel.
Okay.
So it's compounding and growing in a policy, guaranteed. It's not going to do anything but go up.
Right.
So then you're always borrowing more. You're not interrupting the opportunity cost of that money. And then you take it and do your investment. You're making your investment over here while the money's making money over here. You're just making money in two places.
So I guess how would this be different than, say, I mean, your name's Mr. Brrrr. So if you go buy a house cash, right, and the house is an asset, it's making money, you're getting rent, you're doing all that, and then you borrow against it. And so now you still have the asset's still appreciating. You may not cash flow anymore,
Right.
because you have a mortgage, but you still get all the other benefits of the asset. But now you have the cash to go deploy. So you're like still controlling too.
That is infinite banking.
Exactly.
So
I get it.
You know the concept. The reason why it just makes more sense with a policy is because you have unhindered control as a policy holder, as the owner of the policy. And you can own policies on your kids, your wife. I've got 3 on my daughter, 3 on my wife, 1 on my dad, 1 on my mom. As the owner, you have full control. Meaning you take a policy loan, you never have to pay it back.
Right.
If you borrow from your house, guess what you have to do? You have to pay it back.
Yeah.
Or they take the house, right? Because the house is the collateral. Your money you put in was the collateral. They know they're going to get it back.
Yeah. And if you have a stock and it goes down, you get margin called.
Yeah.
Yeah.
And then the other thing too is whenever you're using a policy, if you need the money, I can literally on my phone go onto one of the apps, ask for a policy loan, hit a few buttons, say which bank account I want it to go to. A couple days, I get it. Boom, no questions asked. No financial statements, no credit checks. You borrow from a house, it's going to take you some time, right? 60 days, 90 days. Rate's always going to be a little higher too, right?
Yeah.
Right now, especially 8%. Mortgage, or not mortgage, with policies, again, they play the long game. So they're not changing rates like crazy. I've seen 5%. That's all I've seen. Hasn't gone up, hasn't gone down. That's all I've seen is 5%.
5% as far as what it will pay you?
The borrowing rate.
Oh, the borrowing rate.
So I can borrow at 5%. That's not changing like crazy because they're playing long games. They're
And you said the policy makes 3-ish?
guaranteed 3.25 compounding
Uh-huh.
plus dividends. So with dividends, 5-6%.
So if it made 5%, you borrow at 5%, it's a wash.
No, because you're paying simple interest, you're earning compound interest.
Okay.
So as long as you're continuing to put money through your policy, that's all you're doing. It's a place to store capital. So if you're using it, don't store it in your bank, flow it back to your policy. You're always paying down your balances, so you're accruing less interest. Right? So let's say I borrow $100,000 at 5% and I pay nothing back. I owe $5,000, right?
Yep.
That's true 5%. But let's say I paid back 50% of it. I'm only accruing interest off $50,000 now. At the end of the year, I'm going to owe less interest.
Yeah.
So for having control of $100,000, it wasn't truly 5%. The true rate might have been 3, 2, but it's compounding.
Because you didn't have it fully leveraged the whole time.
Right.
Yeah.
And you could fully leverage it. That's what I do. I fully leverage it, and then I always just flow other money from my business back to my policies. So for instance, I'll take a policy loan, easy math, $100,000, goes into my personal bank account. I then make a note from me to my business.
Okay.
So my business lends me money at 15% interest. The business now has that money. Business pays me 15%, which would be $15,000 for the year. It's going back into the policy every month, $1,250 a month.
Okay.
Right? So it's paying down that loan balance, but the full $100,000, my business is taking it and deploying it. Right? I'm just paying back interest only to myself indefinitely. I never have to pay it back.
Right.
But I'm always lowering it down. So let's say at the end of the year, I've built back $15,000, right? Because
Why would it pay it down if you're only paying interest though? It wouldn't pay down if you were only paying interest though, right?
No, I'm paying interest only on the $100,000 that I
Right.
borrowed.
Yep.
So that would be $1,250 a month.
Uh-huh.
I'm paying that down on the loan balance with the policy.
Well, but with
Makes
the
sense?
policy, don't you have to pay interest too?
It accrues at the end of the year. So
Got
again,
it.
remember, if I borrow 100 grand, I don't pay anything.
I understand now. Okay,
Yeah.
so if you paid off, let's say 10 grand, you're gonna get interest on 90,000 essentially. Okay.
At the end of the year. And it's your decision to pay it or not. What I do,
So what happens if you don't pay it?
it just
So does your balance?
it chips away at your death benefit.
Oh,
Yeah. So again, you never have to,
right.
but you should.
So it'll chip away at the death benefit, like the interest that it's charging.
Right.
Okay.
What I do simply is at the end of the year, the insurance company lets you know how much is owed. Let's say it's $5 grand. I just write a check for my business as a business expense. I pay them $5 grand, so I get a write off. Plus the 15 grand I was paying myself back throughout the year was a write off. Right. It builds back up in the policy. Now I've got 15 grand extra. What can I do? Lend it to myself again. So now I got 115 grand lent at 15%. That's 17.5 coming off my books that year, building back up in the policy. Follow me? And that builds back up. I lend it again. So now I got 132.5 lent, and I'm paying interest down from that on my business. So I'm always just flowing money back, using it again, flowing money back, using it again. That's it. The more you do that, the bigger the policies get.
Because you're just overfunding it. That's why the
That's
policy
it.
keeps getting bigger.
Yep. Just overfunding the policy to the max. Because once you get to the max,
What's the max?
it's called the MEC 7 pay rule. So basically a calculation that each company has. There's only so much you can put on top of a base premium, a life insurance policy, before it becomes taxable.
Oh.
So just overfund. Once it gets to that line, our team knows, like, don't put any more in, and then you just have to start another policy. So
What's the max?
amount of policies?
No, like whatever you just said, like the max before you start paying taxes.
See, that's where it gets a little confusing because there's so many different ways to write that contract. Is you decide the max. You would say, Devin, I think I could do 10,000 a year, 100 grand a year, $1 million a year, 5 million a year, whatever the number is. Let's say it's $100,000 a year. Of that 100,000, there has to be a portion for the death benefit, or it's not a life insurance contract, right? So about 30% of it's the base premium.
Okay.
30 grand. 70 grand is overfunding. Okay. So the more you put in, essentially the bigger the policy, the bigger the death benefit, but the more cash value you have. So you basically determine the limit, and then we build it to where it's not taxable.
So what would the death benefit end up being?
Really high.
But let's just say like you overfunded it $3 million. I mean, obviously you're going to get your 3 million back, but does it, like, what does the policy actually pay?
On a death benefit?
Yeah.
See, that's based on a couple different things. Age and health, obviously. Like the healthier
And you said
are,
part of it is you're putting the death benefit really low. You guys aren't concerned about that.
So you're putting it low, but again, if you put in $5 million, you can't have a $30,000 premium. It'd be too much on top of that premium. It'd become taxable. So your actual death benefit, the base premium on like $5 million would have to be about like $1 million. So that'd be a really, really big death benefit. And then the younger you are, the longer it has to grow.
$1 million is the death benefit.
No, $1 million's how much you're putting in. So you put in $5 million. Of that $5 million, let's say $1 million of it goes to pay for the death benefit.
So
what's the cost?
What's the death benefit going to cost or pay out?
I don't know. That's the thing, because it's all based on your health, your age, but it'd be big. It'd be very, very big.
Like someone like me, what would it pay out?
I have no idea.
It's just a lot.
That's a lot. Like, for instance, that one policy I had, 125 a year.
Yeah.
That starts at 7.6 million.
Got it.
So like, it'd be a lot.
7.6 is the starting point for like the worst.
Right. So if I put in 125 the first year and walk into the street and get hit by a train or a car, trains aren't in the street.
Yeah. we have trains on the strip now.
So yeah, my family would get $7.6 million, but I only put in 125. So the insurance company has a lot of risk early on. The longer I pay into it, the less risk they have because I've continued to put money in that they can go invest.
So what's the cost to all this? Like, how do you guys make money?
Off the death benefit cost. Remember, there's two parts. Paid up additions, which is overfunding. Base premium, which is death benefit. We're just lowering that. So we're getting paid a lot less, 60 to 90% less commissions, but we do volume, right? So I've set up 1,600 policies in 3 years. The average life insurance agent would set up like 6 a year, you know? So
What else? What are they doing? Why don't they want to sell more? What do they sell?
they sell regular term, regular whole life, but
Got
like,
it.
but again, because that's where all the commissions are at, right?
Got it.
So it's not sexy to sell infinite banking because it's
Wait.
lower commissions.
How much are their commissions? Because my term is not even a lot of money. Like, it was like a couple $100 a month.
They're probably getting a couple $100 a month,
They get the whole thing.
pretty much, like 90% of what you're putting in.
How does the insurance company make money?
So they're not paying out of your $100. The insurance company is paying out of their general funds.
Mm-hmm.
So they just have allotted money for commissions, a lot of money for investments, a lot of money for death benefits. So insurance companies are smart, dude. They know how to freaking make money.
So the whole concept with this is that you're essentially trying to make this 2% spread that will eventually grow. You know, there's not really a ton of tax benefits to doing this. There's not anything crazy, you know, like you're still getting access to your money up to potentially 90%.
In the first year. After that, it's more.
Okay.
And
After
every
that,
year
it's
gets to
more.
be more.
But, you know, as that value grows, you can tap into more,
Mhm.
obviously. The big misconception, well, I don't even say misconception because it's true, but I've every time I've been pitched whole life, whenever I look at the sheet that just shows the value of, you know,
The illustration.
yeah, the illustration of how much I'm going to make and the value, it always is like I'm losing money until year 7.
Mhm.
And then year 8, I'm finally ahead. And I'm just like, why am I doing this? This doesn't make any sense.
Yeah.
So how are you getting around that?
The first thing is you said the first misconception about everything that we do. Everybody focuses on an illustration. They don't understand the concept of what we just talked about moving the money. Because really, if they understood the concept, they'd never care about the numbers as much as you are. Think about it. Like, we have 2 alternatives for what we're talking about. You can put money in a bank account, maybe a money market to have access and liquidity, or you could put your money here and have access and liquidity. But one allows you to make money twice. The other allows you to make money once. Because if I put $100 in an account in a bank, I make money once, an interest rate. But if I take that 100 out and I give it to you, and you're going to pay me 12, I stop earning the 1 and now I'm making 12. It's still a good day in the office. Here, I take the 100, I put it over here. I'm making 6, better than the bank. So we're already up on the bank. And that 6 that I earn is tax free. So people that talk about the tax thing, the only thing you've got is like a Roth. It's tax free on the growth. Don't play the tax game because that's not the reason we do this. But now I take this 100 and I take it out and you pay me 12 on that. Now I'm making 12 from you, but I'm making a spread over here. So which one would you prefer? Make money twice or make money once? So that's it. So let's get to your question. When you look at the illustration and you're looking at it, you're saying, okay, I put X amount in every year and it takes me 6 or 7 years to get back what I put in. True statement. Okay. But that's because you're looking at it wrong. Now, the policies we design don't take 7 years. I'm going to be frank about that. That policy probably might have been an infinite banking policy, but I think they were making a little bit more money than I make on them because I know how to strip my commissions down and put the lowest death benefits so that you have the highest amount. But let's just pretend that's what they all were, is a 7-year break even from a cumulative return. A cumulative return would be the right return for a 401k where you put money in and you never take it out.
Mm-hmm.
But are we putting money in and just leaving it sit in the policy? No. Absolutely not. And if that's what somebody wants, is just a place to put their money and leave it, we're not going to be a good fit. We're putting money in and immediately finding an opportunity to move that money out. And that opportunity could be your car. Like, you have a nice car. I like nice cars too. Every car I buy, okay, I take the money from my policy. So I save up enough to pay cash, take the money, the loan from the policy, and I buy the car. And I figure out what the car payment's going to be. So the truck that I just got, it's $2,500 a month payment. I take $2,500 a month that I would have paid a finance company. And instead of paying the bank or the finance company, I write a check every month or a bill pay to my bank, which is the policy. So I took $120,000 out of it, bought the vehicle. I take the $2,500 I would have paid, which I found out by asking them, how much would this car cost if I finance it? $2,500, 6-year loan at whatever, 6% interest. Take that $2,500, instead of giving it to them or putting it in a bank account, I just put it back in my policy, paying the loan down, making interest the entire time on the 120 grand. And now I'm recapturing the interest I would have gave away. Now, just with cars, if I do just that, here's what happens. You get all the money back for every single car you ever buy, drive, and own, and you never have to sell them. So that car out there, imagine if in 5 or 6 years you could get all the money back, but the car didn't have to get sold to get it because you're the bank. So that's one way. Credit cards is another way we use this. We show people how to wipe out debt. If you're giving 20% to Visa, I put money in this bank, take a loan, and I pay Visa off. If I was paying Visa $100 a month at 20%, that's money that was leaving my family. I take the 100 and I put it back in my policy. It's the same dollars. My family didn't have to work harder or work longer. It's the same dollars. So back to the cumulative return. If I'm putting money in and taking money out, putting money in and taking money out to pay loans or credit cards off, to buy cars, to buy real estate, lend it out, cumulative return doesn't matter. Cash on cash return matters. Every dollar I put in, how much did that money make this year? So if I put 100 grand in the policy, how much was the return this year? I put another 100 in next year. What's the return next year? In real estate, the main thing we use is cash on cash return. So because I'm putting it in and taking out, the only thing that matters is how much did that money that I put in this year make me? So that's when we use cash on cash return, your break even, we call it the efficiency zone, is 2, at the worst case, 3 years.
So you're talking the cash on cash would be 2 years if you're actually moving money.
Mhm.
But what would it be like if you didn't do anything? It's going to still be
You
in
would
that.
never call me. So it
Yeah.
would be the 7 years or whatever,
Yeah.
6 or 7 years. Even if it's the best design, it's probably 5 years
Right.
on a cumulative return.
Right. And so the only difference is obviously you're training them how to utilize it to get that return higher. And also too, you're stripping your commissions down.
The way I'm not so much stripping it, the way I'm designing it, I'm putting the lowest death benefit on the plan, which means we get paid off of the death benefit. So I put the lowest death benefit by IRS rules, and I put the most amount of money in. My commission's naturally going to be lower. I'll give you numbers like a $10,000 premium into a regular whole life insurance policy would pay an advisor on minimum $5,500.
$5,500 for
Yeah,
$10,000.
That's a good day in the office, right?
Yeah.
Now you put 10 grand in a policy I designed. My commission's $387.
So why would a guy like you do that?
Volume, scale. I understand volume, and I'm a master at picking up nickels and pennies. That's it. I understand that if I give, I get.
Right.
You know, you've heard this a million times. Zig Ziglar, if you help enough people get what they want, you get what you want.
Right.
But I got to help a lot of people. To date, that's over 5,000. A couple of years, it'll be 10.
So
do that little math on 5,000 people.
Yeah.
It's a good living.
The goal is get as many people through Money Multiplier, charge as low as possible, get them in the door, and then, obviously they're going to do well, and, eventually they'll buy some other stuff from you down the road. Same
Maybe, but
concept
I'm not
as me.
after everybody either.
Right.
I want people that understand the concept and are willing to learn the concept and apply the concept, because if not, I don't want to work with them because it's just a problem client then.
Right.
And they put money in the policy and they're like, hey, how come I'm not making the money like your video showed? What would you do? Did you move the money? Did you do lending? Did you buy a car? No, it's just in the policy. Oh, man. Okay, let's go back to the first beginning. Remember, this is just a machine that we move our money through. And here's the other thing too. Let's talk about that. Let's just say it was 7 years. Okay, it's not in the plans I designed, but let's just say it was. Would you give up access to 100% of your money for a period of 7 years so that then year 8 and for the rest of your life, which I don't know, how many years do you think that is? You got 70 years left after 8 years?
We'll see.
60, 70 years?
Yeah.
For 60 or 70 years, that every dollar you put money into that machine, it printed and gave you back more money than you put in. Every year, and every year you got to raise. And you didn't have to work any harder. It's like a business. Most businesses lose money the first 5 years, right? It's a statistic, 5 years. You're creating a bank. Your bank might not make money right out of the hole. It will, because you'll move it, but it might not, as a standalone, make money. But we always build businesses and put energy and effort into those businesses for 5 years, even if we don't make anything or barely get by, because we know the fruits of our labor will pay off someday. In these plans, in the worst plan, the 7-year plan that you said, even that plan, if you put money in, if I put $1 in that year 7, I'd probably get $1.50 back for every dollar I put in.
Mm.
In the 10th year, if I put $1 in, I'm probably getting $2 back for every dollar I put in. It's just compound interest. This is just mathematics. It's not my opinion, not speculation. It's mathematics.
Right.
So would you give up 7 years of gain to then for the rest of your life have a gain and a return on your money that you didn't have to work any harder for or do anything to get?
Mm-hmm.
That's the question. So when you ask, like, do I want the most amount of people? I want people that understand that. But then I'm going to shorten that curve. And are you willing to give up access to all of your money for 3 years so that the rest of your life, every dollar you put in, you get more back than what you put in.
So I think a question a lot of people would be wondering is, okay, that's great. Basically, we're talking about making an extra 2% as long as,
That's only the first year.
right, as long as I, go use my money effectively. What do you think's a way that, I guess you are training people this, but how would you say people should invest their money? Like what's a lot of ways people are doing it?
I just look at what the wealthy do and what insurance companies do and what do the banks do? Lend money. So how I've made money is first I took back all the money I was giving away. I looked at my balance sheet or my budget and I said, who's getting money from me every month? Car payments, credit card companies, lines of credit. And I started the process of going through all the places I was losing money and I took it all back. I paid those loans off and I just kept making monthly payments, but I made them to my bank. After that, buying cars. We always buy cars. We're always going to. We need them. I started financing my own cars, copy machines in my office. This just happened. The guy came in to redo our lease on our copy machine, and he said it's going to be $171 a month. I said, how much is the copy machine? He said $8,900. I ran the math. I said, if I just take $8,900 out of my policy and I pay the 171 away, 171 a month, I would give away to him back to my policy. I end up making, I think, about $4,000 over a 6-year time frame on that copy machine. Yeah, I mean, it's endless what you can do. But my preferred choice is real estate. I come from a real estate background. Greg, that thing sank in my mind. The ultimate in real estate is being the bank.
Mm-hmm.
Lenders always made all the money. Whoever I borrowed money from for my flips always seemed to make as much or more than I did, even on the best flips. So I'm just like, okay, well, if that's the case, why don't I just lend money on real estate? So I started lending money on real estate. And that was several years ago. We made a lot of money in flipping, kind of like similar story. And then from there I had money. And I'm like, well, what do I do with all this? I don't want to buy more real estate because I got burned out on it. I don't want more real estate. So how do I make this money work? I started lending it out. Problem I ran into was people would bring me deals on a yellow piece of paper with an address and say, hey, can you lend me 200 grand on this? I'm like, dude, you never been to a bank? Like, is the bank just give you money when you bring them a paper? No. So I started the process 2 years ago of teaching people how to be good borrowers. I wrote a book, Private Money Guide, showing people this is how you're a good borrower and this is how you're a good lender and this is how you protect yourself. So I built this whole infrastructure and this whole process on the proper way to lend and the proper way a borrower should build a deal. We called it the perfect loan proposal. So then I started lending to good borrowers because I was developing good borrowers through education. And all of a sudden my friends that had money would be like, hey man, can I lend on a deal or two with you? Sure. So we'd land on a deal or two, and then 3 or 4. And then I'm like, well, this is a pain in the ass. So then I had to create a platform to kind of track it all. And I used Slack in the beginning. I would invite them all in, and then they would just lend on deals.
Mm-hmm.
I got this idea one night. I remembered back to when I was a pro snowboarder. And when I was a pro snowboarder, I was always single. I was smart. So when I'd travel to an event in Colorado or Utah or Big Bear, I wanted a companion. I wanted to hang out with a girl when I was there. So dating sites became really important. I used eHarmony. Profiles on one side, my profile here, I would scroll through, find people in Colorado or wherever I was going to be, and I would connect the dots, and it was pretty successful. Not always, but I'd have somebody hang out with that at that event. But then I thought, why doesn't that exist for money? Why isn't there a dating site for money? Because there's only 2 types of people out there, Ryan. There's people that have money that want to make more money, and there's people that need money to make money.
Mm-hmm.
Both me and you both sit on both sides of that fence.
Right.
But everybody, for the most part, sits on one side. I just solved the problem. First, I solved it for myself, then for a few friends. Now, in October, I'm launching to the U.S. I'm going to solve it for millions of people.
I love it. So tell me about this. I'm a big guy on creating businesses that solve problems because that's basically every business I've ever started, was people constantly coming to me with a problem. And I'm like, I guess I'll just do it. Mm-hmm. And you were telling me about this private money club. And the more if you guys can't tell listening, I'm always picking apart ideas and like, where's the catch? How would this fail? What's wrong with it? And if I can't find anything that like is a big enough problem, I'm like, okay, that's a good idea.
Okay.
And I think what you are designing with Private Money Club is really cool. So why don't you tell people about that?
Yeah. So I took the same model as a dating site, 2 profiles, a lender's profile. They put all the specifics in based on a criteria that we give them, kind of like building a Facebook or an Instagram profile. And then the borrowers do the same thing, but the borrowers then have an additional level of training that's basically brought them in, once they're a member, that brings them into it to teach them how to design their deal. Here's the things you would need. Think of Zillow. Every Zillow deal you look at is identical. They all look the same info. So if somebody wanted to look at a deal, they know where to find it on Zillow. Well, I've just created that template. And then I said, if you're going to be a borrower, well, lenders are going to want to know some things about you. Like, let's see what you look like, behind the curtain. How much money do you got? What's your income look like? Where are your statements? How much money you got in the bank? So we ask for personal financial statements and tax returns and all this, but we've created a template for all this. So now once they create all that, they post their deal on the site. Now, so the new app that's coming out for us is just like Tinder. Swipe left, swipe right. So
Mhm.
let's play two sides. You're a borrower and you need money for your deal. You grab the app, you select lenders, and you start swiping left through all the lenders. You read the profiles. This guy's got 200 grand, looking for 10 to 15%. Boom, you're swiping. And when you find one you like, you swipe right. And then that brings you into a chat inside the software. The chat then walks you through a comprehensive process of very much like that one I built earlier. And it just solves the problem. Same thing. If you're a lender and you want a deal, you swipe left. You swipe right, it notifies the borrower, and then the borrower sends you the deal. Boom, now you're engaged in a conversation. Listen, not all deals are going to work, but I don't get in the middle of the deals. This is the thing that was, obviously I knew that was where the money was. The money was, let me try to find a point or two I can make on every deal. I had an SEC attorney that I hired and I said, can we figure this out? He said, don't you even ask. He said, it's never going to work. It's going to get shut down. So I said, okay, well, all right, it's just going to be a membership site. So we created, I just draw a circle, lenders and borrowers. And in the middle is the education and the process. And we just charge a membership fee for it of $1,000 a year.
Yeah, I think that's amazing. Like that business model is so smart with, hey, $1,000, you get to interact with as many, if you're a guy looking for money, you got that. If you're a guy who's got a bunch of money, you can meet other people. It's kind of weird, the dating for lenders and borrowers, but it definitely works.
It just gets your mind working. Like
it's the dopamine of, man, am I going to find a good private lender today? It's going to be interesting. Yeah. Okay, man, am I going to find a new investment opportunity?
It's fun. It's almost like gamification.
Fun. It is gamification, just to kind of in a weird way, since it's like a love app.
Money is a game. It's a tool.
Yeah.
So it's just teaching you how to use that tool better for two different types of people.
Yeah. So when is it going to launch?
October 14th. It's already open, but it's in beta.
Okay.
So October 14th, we've got, in my life, okay, this will be the single biggest business thing I ever do.
Right.
I love Steve Jobs, and I've studied the launch of the Mac and the launch of the iPhone. So I am doing a launch just like that. I've spent a stupid amount of money, hundreds of thousands, to prepare for this launch on October 14th in Sundance Resort out in Utah. So we're doing it right there. We rented out like Robert Redford's best lodge. We've paid a company to build stages and the craziest lighting stuff, because I watched Elon's stupid Cybertruck. I'm like, that was cool. That smoke thing was cool. That
Even though
lighting,
it didn't work, it was cool.
We know not to throw something at the window, so we're not going to do that. And then like we're going to basically do that launch there, and we're going to launch the US for the very first time. I've never advertised it. We have just under 200 members right now that have run about 20 million of deal flow through in beta 1 and 2. So now we're going to launch with a brand new site that I've spent, all done and said, I'm up about 400,000 in development and engineering, and it's been a long road. But dude, it is so freaking good and so cool, and I can't wait to bring it to the world.
Yeah.
It's my passion.
Is it going to be on iPhone and Android?
Everything.
Everything.
I hired a developer that probably charged me way too much, but they had the vision like I did. I didn't want a developer that took orders. I wanted a developer that was like, this is the coolest freaking thing I've ever heard of since.
Yeah, I'm passionate about it. Let's go. Like, let's get this thing made.
So it's just about done. And October 14th, the new version launches. It'll be available for the entire United States. People can check it out now. They just go to privatemoneyclub.com. You could get in on beta and you could put your deals up. There's probably 40 deals on there right now and about 120 lenders.
So is it only on like desktop, or does the app work?
Well, the app is just it's like any website.
Yeah.
The app retrofits but it's clunky, man. I'm not gonna lie. If you're gonna try to do this on your phone, like as it is today, it's clunky. You won't like it.
Well, the real thing will be much better.
Yeah.
No, that's super dope. I'm definitely gonna mess around with it, dude, because like I think that's amazing, and I think it's a good spot for us to post our deals and syndications, and get some of these guys. People don't have to be accredited either, right? Anybody can just sign up.
No. And if you need accredited, we're going to have a separate thing at the very beginning when you enter that room in the middle, like the lender and the borrower, or if it needs to be accredited, you're going to be able to mark it like must be accredited. And then they're going to have to prove that they're accredited, sign a disclaimer. So I've got a really good SEC attorney. So like if you post a syndication deal and you need accredited, when you get together with like somebody that's going to lend on it, they're going to have to basically do the accreditation stuff right there on the site.
Right.
And then that would report back to you.
Right. No, I love that, dude. So that's where majority of your focus is going to be, just launching that.
So like, this is where I get to bridge like the world that I knew in Wall Street. Cause obviously I was, Series 7, everything. I understood SEC very well. Actually, sometimes, didn't like them, but FINRA and SEC. So I bridged that world to now the real estate world in my passion project. It solved my problem because I make a ton of money lending money now. So if it worked for me, how many people's lives can it change? And what started out as a small little thing, I get these testimonials of people that I've changed their life, and I didn't know really why, but they didn't know how to make money and turn an income on. They had money, they didn't know how to make an income from it.
Right.
I just connected the dots and said, hey, here's how you earn income just like a bank.
Yeah.
And then borrowers, they couldn't get funding because they didn't want to go hard money, or hard money lenders just ran them through the same rigmarole. And there's no institutional lenders on this platform. None. It's mom, pa's, brothers, sisters, coworkers. No institution. We do filter for that.
Awesome.
And so we're helping the person that needs to be helped instead of helping
The big
Wall
boys.
Street and the big boys.
Yeah, they don't need any help.
Nope.
They're good. Well, dude, that's super dope. I'm super excited for that. Once again, that's privatemoneyclub.com, right? So I think you guys should definitely check that out. I will say, on the infinite banking side, I've definitely been enlightened on how it can, work the right way. For me, I was just always hung up on the 7-year deal and like the fat commissions up front. I'm just like, man, this doesn't make sense. But with the way you're talking about structuring it, I can definitely see it making way more sense.
Here's what we've done, Ryan, on that
yeah.
too. I don't mean to go back to that, but really quick on YouTube, and you're big on YouTube too. I've created case studies, real investors, real estate investors using this, showing real numbers and how they're doing it. It's the best way to learn. Like watch actual people using it and see how it works. And that's what we've done a really good job of in our education, is not just saying, hey, here's this concept, here's this illustration. No, like let's find out how Devin used it. Let's find out how Tess used it. Like, let's see how other people are using it. And we just keep creating case studies.
Yes. And what's your YouTube channel called?
The Chris Noggle. So you just at the Chris Noggle.
Yeah, the Chris Noggle. So guys, go check out the YouTube if you're interested in that. Go follow Chris. He's got a ton of great content going on. Obviously, this guy's a wealth of information in many things: snowboarding, banking, money.
Have you heard
crazy.
of captive insurance?
Yes.
I've seen people talk about that as a way to like not pay taxes too.
Yeah. There's so many different ways, dude, to get around taxes. Like I've got like the cheat code of all cheat codes, and this is the wealthy way. So we're going to share the cheat code.
All right, let's hear it.
You might know about this. A lot of people just don't. Even when I share with really successful people, they're like, really? You can do that? It's properly structured foundations and trusts.
Okay.
If you have a properly structured foundation, a foundation is tax exempt, IRS tax exempt. And then if you have certain trusts in place where the beneficiary of those trusts is the foundation, you can literally avoid all taxes legally. Yeah. It just has to trickle through a system correctly to be within the tax code. So I set mine up. My business partner Sam is about to set one up. Chris Noggle has one set up. Brent Kessler has one set up. And basically, like this last year, I saved $400,000 in taxes. Crazy.
So how does that work? Like you set up a trust and a foundation. How do you guys like? I mean, how is it legal? How do you access the money? And like,
So,
I don't get it.
Dude, this could be a whole
Yeah.
podcast topic right here, but it's to keep it simple. I've got, I think 7 companies, 7 LLCs, right? So all these LLCs are up here and they're basically owned, not by me, they're owned by my management company. Okay. So my management company owns all these LLCs. So any revenue coming in, it can charge a management fee to take the taxation off the LLC's books. Right? Now it's in the management company. It holds the money. That management company, the beneficiary of it is the family trust. So I just make a distribution to the family trust, and then I can pay all my insurance policies. I can pay for my mortgage on my house. No taxes. Whatever I don't use, I can make a distribution to my business trust. For my business trust, I can use all the money. Anything left over at the end of the year, I just have to make a donation to the foundation. Donations are dollar for dollar write-off. Make sense?
Somebody was telling me with donations, now you have to, because it used to be like 100% you could donate of your income. Now it's like 50% or something. Have you heard that?
Yeah. It's that's part of it too. Is your gross income you can donate if it's cash 30%. So if you make $1 million on a W-2, you can literally donate 300 grand. So now you're only paying taxes on 700. If it's an asset, it's 20%. So you can donate an asset 20% comes off of your books.
Yeah. Well, it used to be, I think the rule I'm thinking about is you used to be able to donate up to 100% of your income. So if you made $1 million and you truly just wanted to go give $1 million away to charity, you could.
Wow.
But now I think it's, I want to say 50%, up to a certain amount of money, which I think is like 5 million.
I don't know that rule.
Someone
would just
fact check me in the comments.
This would just be different because it's a trust making the donation to the foundation.
Yeah, I mean, I guess at that point, are you just operating your life and stuff out of the foundation?
Great question, dude. So the foundation has a 5% expenditure. So it has to spend 5% of whatever it holds in assets. Let's say it holds $1 million. It's got to spend 50 grand.
Uh-huh.
So that 50 grand could be paying for that desk, paying for,
Yeah.
you know what I mean? It could be a trip with your family to talk about the foundation,
Yeah.
right?
But you don't need a foundation to do any of that. You could just take that right off anyway.
Right. But think about what I just said. You're only paying 5%. I paid no taxes on anything. So there's a whole bunch of money in this foundation. I just got to spend 5% instead of being taxed 40%.
But I guess what I'm saying is, how do you access the foundation's money then at that point?
Because you control the foundation. You're the trustee of it. So there's rules in place where you can't like self-deal. So I can't just like write myself a check to go buy some new J's, right?
Okay.
So basically what you have to do is from your businesses, you keep back whatever your lifestyle is. Let's say your lifestyle is 10 grand a month, keep back 120 grand a year. That's what you pay taxes on.
Yeah.
Everything else goes into the foundation, and then you can invest with it, make loans to your businesses from the foundation. You can do so many different things. It's crazy.
So, yeah, that's an interesting one. I guess somebody listening to this would probably be thinking, well, which one should I do? Should I do whole life and infinite banking, or should I just do that?
This is like a high level thing. It costs $95,000 to set it up. So like
Wow.
most people, like they don't have a tax problem. They
Yeah.
got an income problem. Like if your tax bill is 40 grand, why would you spend 95? Just pay 40,
Yeah.
right? But if your tax bill after write-offs, after depreciation, you're still paying out like $1 million a year. You have a tax problem.
Yep.
Pay 95, don't pay $1 million. You know what I mean? So for most people, it just doesn't make sense. But for people that are really high earners and they just are tapped out on write-offs, it makes a ton of sense. Infinite banking, I think, works for anybody.
I wonder if the foundation can invest or like give loans and stuff.
Yes. I'm not an expert on this, so I should have prefaced with, this is not advice.
Yeah.
This is just what I do.
Yeah.
So I'm not a tax attorney, but I have a tax attorney. And whenever I have questions, I'll like call them and ask and
Yeah.
just make sure I can do things correctly. But yes, you can loan from the foundation.
Got it. The people in the comments are gonna be like, dude, you're gonna get all the fact checkers.
Oh, for sure.
Yeah.
I'm trying to, off the top of my head, it's 503C.
Yeah.
Is that what it is?
Yeah.
501c3. That's what it is. So they can look that up. That's the foundation, 501c3. And then it's filing on a 1041 tax return, not a 1040.
Got it. Yeah, we're actually in the process of getting my foundation done, but not for this. So Wealthy Kingdom, which is our Christian entrepreneur community. Right now, we've been going through it for like months trying to get it turned into a nonprofit. And I mean, just for the reason of, so we do become tax exempt. And so we're not paying taxes on, anything. And we can go out there and make it happen. And then people can actually start donating to us and all that other good stuff. So
you'll basically have the same thing. You just wouldn't have the other parts of it, the trusts. The trusts have to be structured properly to be in conjunction with the foundation for that all to work.
yeah, but I don't want to commingle anything like,
Right.
yeah, it's its own thing, just
Right.
operating for its purpose.
Right.
But I have heard of rich people doing the foundations for the tax reasons and all this stuff.
Yeah. Bill Gates, Bill and Melinda Gates Private Family Foundation. That's the same structure. Mark Zuckerberg has one.
So you think they're all running? They're running like their foundations as both, essentially, as like a tax haven for their own income plus whatever their passion is.
I think so, because like you think about taxes, what it is, it's social capital, right? It's either voluntary or involuntary. So like if you're using this structure like Bill Gates and everyone does, and they've got all this money in the foundation, now they can decide what that capital goes towards, right?
Right.
Curing cancer, I think he's trying to cure AIDS, right?
Dude,
I could be wrong.
All I know is he's buying up all the farmland, and all this conspiracy theorists want to know why.
So again, I don't read the news
Yeah.
much, so I don't really know what's going on. But the fact of the matter is,
Well, and they're divorced now.
you've got social capital, taxes. That's what it is.
Yep.
Voluntary or involuntary. So if you have it in the foundation, you can decide what it's going to go towards. If you're just paying taxes, what's it going towards?
Yeah.
It's involuntary. So I think it's a way for just people to pay less taxes for things they don't know what it's going to be for, and control more of what that is, because there's that 5% expenditure.
Right.
And you have to make a donation, or you have to make a contribution to something. So it's dude, it's crazy. The more I've learned about it, it's made everything with infinite banking just more powerful, because I'm able to flow all the money through these policies and pay them with tax-free dollars.
Why is it $95,000? Just because people, it's just so complex to do, and to make sure you do it the right way so you don't
Yes.
go to prison.
Yeah, basically. And then my tax attorney like does all the paperwork, make sure everything is correctly filed, and
Right.
like, yeah, basically make sure I'm not in prison.
Yeah. That's what it sounds like. I'm like, that sounds intense. But back to like the whole life side. So one thing that I remember when somebody was pitching me whole life and an infinite was like the first 7 years or something, you're negative.
No, that's like a regular policy. You are.
Yeah. Because they were just like, yeah, I mean, this is how it works. Like you can put however much you want into it. And they're talking about the same concepts of like overfunding it and stuff. But then the problem was you're negative like the first 5 to 7 years because of the cost of the policy or something. I don't know.
Yeah, they just must not have been building it right. They probably had too high of a death benefit, because remember, that's the cost.
Right.
So if the death benefit's lower, the growth outweighs the cost quicker. Does that make sense?
Yeah. And I think these guys would probably, I would say they were doing it with that,
Yeah.
like a high death benefit.
Yeah. Which it's, I don't think it's doing the right thing, because, but it is at the same time, because if you pass away, your family's taken care of, tax free, right? They're just doing it more for their commissions.
Yeah.
You know what I mean?
A death benefit is tax free.
Yep.
Wow.
It's income tax free. There's estate taxes, I think, over 21 mil. Again, part of the foundation. I could be wrong on this. Don't quote me, people, but I believe that also makes there's no estate taxes if it's within the structure. So that's cool too. So like if you got $30 million of a death benefit, all 30 million is income tax free, but 9 million is estate taxed. I don't even know what those rates are.
Right.
But at the end of the day, if you give your family 30 million and they're mad because they got taxed a little bit, it's like you're looking down being like, really? Really?
You know what? Let's give that back to my foundation. These guys don't deserve it.
100%.
Yeah, that's something, man. But you got a newborn on the way.
Yeah, man. Super excited about it.
Yeah.
Super, super excited.
Are they going to be infinite banking at before one?
She's got a policy already ready in underwriting. As soon as she's born.
She just bam,
Yep.
insured.
Yep. So I think it's 2 weeks old they can have a policy.
Oh, really?
Yeah.
That's crazy.
Dude, if you think about life insurance is based off compound interest.
Okay.
Compound interest just takes time.
Yeah.
The longer you give it, the bigger it gets. So if she's 2 weeks old,
Yeah.
by the time she's our age, she's going to be filthy rich.
Yeah.
Right. And yeah, it's one of those things where like the Rockefellers, everyone knows the Rockefellers.
Yeah.
They have actually become wealthier over 9 generations.
Yeah.
How do they do that? They have trusts in place and life insurance policies. A trust basically just dictates how the money's spent when you're gone,
Yep.
right? So if all this money comes into a life insurance or from a death benefit into a trust, but the trust says, you only get $1 million when you're 25.
Right.
You only get another $1 million when you're 30, whatever the rules are. They can't go broke, because then if every person in the family has a death benefit on their life, they're going to die. trust becomes even bigger and bigger, wealthier and wealthier.
Mm,
That's one thing that's guaranteed in life.
death. People say death and taxes, but like you're talking about, you can avoid taxes. But if you live to 150, you can almost avoid death, but then you still get got.
I want to preface with this. You can't avoid taxes. Like, you still have to pay them. I have kind of a cheat code.
Okay.
Like, my wife is a W-2 employee.
Yep.
She makes very, very good money, enough to live our lifestyle. We donate 30% of her income to the foundation. So we pay on 70% of her income.
Mm-hmm.
That's enough to live our lifestyle, more than enough. So all of my money, I don't have to pay taxes on. If she wasn't working, though, I'd have to keep money back to live our lifestyle. So I'd have to pay taxes on that amount. Everything else could go into the foundation and trust structure.
So you're saying that you guys live off of her 70% that she makes. 30% goes into the foundation tax-free.
Yep.
Then your money's going into the foundation tax-free. And then that money is getting reinvested into things.
Yep. Paying for insurance policies, paying for the mortgage on our house, because the house is owned by the family trust.
Right.
So the bank account from the family trust can just pay the house payment.
Got it. So now you're not getting taxed on your house payment anymore.
Exactly. Because most people think I'm going to write off the interest. We're writing off the principal and interest.
Yeah. Because you're not paying tax on it.
Yeah.
Interesting. Okay.
You can do that with anything. To an extent, it doesn't make sense. With some stuff, it's higher higher liability, like a car. If you put a car in the trust, you could make payments on it with the tax-free dollars, but car, you're more likely to get in a wreck, right? Someone could sue you. And if it's owned by the trust, then it's like, it's easier to penetrate and like start doing damage to it that way. A house, like,
doesn't like, but a foundation's got to have like a purpose, I think.
It does. Yeah. So when we set ours up, we have like, it's so broad. Like, the purpose can be agricultural. It could be, I forget what the lists are. There's like 6 different things.
The only reason I know is because when I was doing wealth, so let me take like 3 steps back. So I first had the idea to do a foundation back in 2021, and not for taxes or anything. Just like, I wanted a true, just nonprofit, for a cause. And they're like, all right, so what do you want it to be about? And I said, I don't really know yet, but something Christian based. I'm just like, I don't know exactly what it's going to be yet. And they're like, you got to know, you got to be like very pinpointed about who you're going to help, what you're going to do, what are the programs you're going to offer, how are you guys going to raise money? Is it public? Is it private? What are all these things? And I was like, dang, dude, I don't have the answers to these.
Yeah.
And they're like, all right, well, just, go back and think about it. And when you're ready, come back. And so like, we thought about it and I said, honestly, nothing comes to mind right now. So I'm just going to put it on ice.
Yeah.
And so I put it on ice for years. And then Wealthy Kingdom came about. And originally I was just like, you know what, it'll just be a business and like, I'll just run it at a loss. I don't really care. Like, the same thing will happen. But the problem is you can't really have anyone donate when you do it that way. And I know, like, I started to get a lot of people who are like, dude, I want to support the mission and what you guys are doing. And I was like, okay, well, I might as well start going down this path. And then that way too, the stigma of it would go away of like, oh, he's just trying to make money off of faith. And I'm like, nah, this is like this whole other thing. Like, you can go audit it. I don't really care.
Yeah.
So yeah, now we're there. And so when I went back 2 years later, I said, hey, this is what we're doing. Here's what we've already done. We're already got people going. And they're like, this is perfect. You guys have a clear mission. You have a way for people to join, all this stuff. And now it's just a matter of waiting. But I've also been told that anything that has the potential to self-deal, they're going to knock it off. They're not going to let me do it.
Right.
And so I'm just like, I mean, we'll see. But that's why I was like, man, how are you doing this without like a mission and all this? Because I'm already going down that path and it's really hard.
That's one of the rules, right? You can't self-deal.
Yep.
That's big. You can't do that. It sounds like it's 2 different foundations. Like, yours is like more of a nonprofit. This is a private family foundation.
Yeah. And so we are going to be a public nonprofit that
Totally
anyone
different.
can donate to.
Yeah, totally different. So,
Private's way easier.
oh, 100%.
That's what they said.
100%.
They're like, but you're going to be public because you're trying to go like massive and get donations and everything.
Yeah.
Yeah.
Makes sense. Just two different things. But a lot of the same rules, like the self-dealing you can't do, right? I don't know if with the public one you have that expenditure rule or not.
I remember with the public one, because like with a private one, you could fund 100% of it. There's no like cap. You don't have to get other people to do it. But with the public one, there is a rule that you personally can only represent, like I want to say 20 to 30% of the donations.
Oh, okay. Yeah.
Meaning that you have to go out there and raise.
Got it. Yeah. So you couldn't just donate all of your money to take it off taxes for that purpose.
I mean, you could if you were getting in so much other stuff.
Got it.
So if I made $1 million, I would have to go get 2 million plus of donations on top.
Got it. Yeah.
Yeah.
Makes sense. It's just cool things like this. I wish they taught in schools.
Yeah.
Like this stuff intrigues me. And in schools, we learned about like things we'll never use. This is real life things that people could use and could benefit from.
Yeah.
You just have to learn it. You have to take time, and you know, it's the stuff you have to seek. It'll never be taught in schools.
No,
Ever.
dude, I was with some rich people one time, and anytime
I love.
Yep. So I was with
I was with some rich people one time.
Yep. So this one time I was hanging out with these rich people, and you know, it happens a lot of times, but this was just one time that stuck out to me. Was they're like, yeah, once you start learning like all these things the rich people do, you know, you'll learn why they don't pay taxes. And I'm like, what do? They buy real estate, and they're like, yeah, you know, obviously everyone does that, and that's a big part of it. And then like same thing, I'm like, all right, do they got like, you know, life insurance and stuff? I'm sure they got some of that. I'm like, yeah, you know, that's another thing. And then I'm like, okay, so what else? Then, you know, the foundation, I'm like, all right, you know, I knew that. And they're like, yeah, you know, another one's art. And I was like, art?
Oh yeah.
I'm like, what do these guys do with art? And I was just like, that went down a whole new rabbit hole of what these guys are doing. And yeah, long story short, it's like these guys will buy art and then like whatever, they buy it for whatever they buy it for. And then it gets appraised at some crazy value. So they might have only bought it for like, I don't know, 100 grand. Let's just say only, but let's just say it was 100 grand from like some famous artist or something. And then it gets appraised at 500,000, and then they'll just donate the piece of art with the value at 500,000 to their whatever, their foundation or anyone's thing. And then now they just got a $500,000 write-off. And then guess what? The art is still hanging at their office in the house. It's still there. And I'm just like, okay.
Cheat code.
I understand what these guys do. Okay.
It's insane.
Yeah.
And it's not that difficult. It's literally just it's not that hard. It
Yeah.
really isn't. Like I go back to this all the time. Is like, I'm not the sharpest guy in the world. Barely graduated high school, D average. I was cheating off tests. Literally cheating off the wrong tests, obviously.
Yeah. Wait,
But-
how do you're like the worst cheater ever.
Ever. Or like, I would just like the bubbles, you know, I had multiple choice. I would just like,
You're dyslexic. Zigzag, draw something.
yeah, maybe right down the middle. Somehow I passed the D average.
Yep. I wonder if they still got Scantrons. They do? All right. They still use
Scantrons, that's what it was.
Yeah.
Yeah. So
I'm surprised you knew
we're
that.
about the same age.
Yeah.
You're 34?
I'm 34, but I'm
Yeah.
surprised you knew that, being such a bad student.
Yeah. But just like stuff like this, it's not that difficult. It just seems difficult because you don't know about it. Until
Yeah, you don't know what you don't
30-some
know.
Years old,
Yeah.
right? When you're a kid, this would be so easy to soak up as a kid.
Yeah.
For instance, my daughter, she's had a policy since she was 12 years old, life insurance policy. So she hears me talk about it all the time with clients. Just hears about it. She's
Yeah.
not sitting there studying me saying what I say.
Right.
I did a TikTok live with her, or maybe it was an IG live, where people would ask questions about infinite banking. And it was just her and I sitting on a couch. I had her answer the questions. And like, she would look at me and be like, was that right? And I'm like, yeah, spot on. Like,
Yep.
she knows the stuff better than 99% of people just because she learned it at a young age. Kids' brains are sponges, man. They learn so easily. As an adult, we learn something new. It's like, it's so complicated to us, but it's really not. It's just we're programmed. Everything else is right. There's a quote by Will Rogers is the biggest problem in America is not what people don't know. It's what they think they know that just ain't so. It's true, because if you think about, everyone thinks 401ks, put your money in a 401k. That's what they think is a great retirement vehicle.
Yeah.
It's just not true. You're giving up access to your money now while it's worth the most because of inflation. It's going to be worth less tomorrow.
Yep.
Let alone when you're 60.
Yep.
Right? You're avoiding paying taxes now when you know what the tax rate is to pay the tax rate when you're 60. Who knows what it's going to be?
Yeah.
Right? Mm-hmm. You're going to have to pay the taxes at some point. Pay them now when you know what they are.
Yeah.
You're paying taxes on the harvest in a 401k instead of paying it on the seed today.
Yeah. The seed costs can be way lower today.
Yeah. But people are so programmed to think a 401k is the best retirement.
Yeah.
It's
What's that dude who's got like the billion? Is it Peter Thiel? Peter Thiel. His thing, his like self-directed IRA or something has turned into like billions of dollars.
Really?
I can't remember. I think it's him.
Self-directeds are actually pretty good. I like self-directeds. If you're going to do a retirement, I think a self-directed makes sense.
Yeah. And by the way, for anyone who, I'll put a link down below. For anyone who wants to do self-directed, we've got a, it's not even an affiliate. Like it's just a company we refer our investors to.
Who do you use?
Horizon.
Horizon, Greg Herleen.
Yep.
He's
So
the
Greg's,
homie.
Greg's been on the podcast. And so, yeah, by the time this releases, him and I are actually doing a webinar. But basically, like with the self-directed, you can get the money out of a 401k, right? Get control of it. Costs you nothing different. It just goes into a self-directed IRA. And then now you can go invest it however you want. You could put it in real estate. You could put it with us at Pineda Capital. You could do a ton of different things. But the point is, it's better for you to have control of the money than not.
Yes.
And so for me, it's like one of my new strategies with Pineda Capital. I'm really going to be trying to help people understand that. Whether they invest with me or not at Pineda Capital, I'd rather them have control of their money.
Self-directed is an easy thing for people to understand. I think it's really easy to understand that. It's just, people know what an IRA is. It's just self-directed.
Yeah.
You direct where it goes.
Yeah.
It's super easy to understand. And then, yeah, if you have control, you have less risk
Yeah.
with anything. If you're driving your car and the brakes go out, you've lost control of stopping the car. So your risk of crashing goes up.
Yeah.
Right? You lose control of your money, you have a risk of losing it. So the more control you have, less risk you have. So I think if you're going to do a retirement, self-directed makes sense. The only thing I don't like about it is you don't have total control, meaning if you do an investment, that profit has to come back to the IRA. You
Correct.
can't take it out
Yeah. Yeah.
or you're penalized, right? That's what I like about infinite banking is like you can use it for whatever you want. You go make profit in something, I can
Keep it.
keep it. I can buy some new clothes. I can take a trip with my wife.
Yeah. Self-directed has a lot of rules for what you are allowed to invest in.
Yeah. Yeah. So, but again, if someone's going to do a retirement account, self-directed, I think is the best way you could do it.
Well, like even if you already have a retirement, like, you know, you're working W-2, you've been building up your 401k, you got some money in it. It's like, well, why are you just keeping it in a 401k, like letting, you know, some other guy just hopefully make it grow 4%, you know, like take
There's
control of it.
management fees and
Yeah, take control of it. Like at least either invest it yourself, go buy a rental property, or give it to somebody that you actually want to invest with.
right.
You know, whether that's me or whoever. But don't just take the 401k that your company gave you and just assume that they're actually doing what's best for it.
The funniest thing about those, man, is like the company wants you to put money in there because it's a write-off for them.
Yeah.
So like Danielle, my wife, has one, and I was like, stop putting money in it immediately. Like stop. Once I learned about like how money actually worked.
Yeah.
So she stopped. The company automatically like started the contributions the next year. And she noticed like,
Why are we recontributing?
yeah, she's like, this is weird. They just restarted it up. If you don't contribute anything, they started it for you because they want you to do that because of the match. The match is literally a write-off for them.
Yeah.
It benefits them,
Yeah.
right? Mm-hmm. But they're matching something that you're not going to have access to for 30 years.
Yeah.
It's like, who cares?
Yeah.
So 401ks are the worst place you can put money, in my opinion.
I think, man, I want to say it's Peter Thiel, but he had like a huge I think it's a Roth IRA. Let me see. Peter Thiel. Yeah, he's got a Roth IRA. It's amassed $5 billion in his Roth IRA.
Wow.
And really, the way it did it was he started putting his, good investments in there way early on, like decades ago. And then all of a sudden, these investments, they popped, like PayPal and all these things he invested in just went nuts.
And there's no taxes.
There's no tax on it.
Because it's a Roth.
Yeah. So he has just this $5 billion thing that maybe he paid. I don't know how much he put into it originally, but he did pay tax on, say, the tens of millions that he put in.
Right.
Maybe even hundreds of millions that he contributed. But then its growth of this 5 billion has been tax free.
Yeah.
And whenever he wants to access it, he'll get it tax free. And I'm sure he's just continuing to use that money for his next investment. So that thing is going to be worth friggin' tens of billions.
And that's the whole thing that Greg talks about. That's Greg's whole thing at Horizon Trust.
Yeah.
So he's actually at the mastermind, I think, right now with Chris's thing. So,
Oh, okay. He was literally texting me today.
Yeah. You should stop by. I know you got the wedding tomorrow, right?
Yeah.
Stop by today. They're having something tonight, I think. It started at 4. I don't even know what time it is. What time is it?
It's 4.
Okay.
No, I don't know. It's close to 4. I'll stop by. I don't know. I'm busy with you right now.
I'll stop by now.
That's funny. Where are you guys at?
Virgin
Okay.
Hotel. Yeah. Super cool. It's owned by Hilton. I didn't even know I had status with them. So we get to the front desk and we got our room upgraded to like a suite. And I didn't even know.
It changed.
Done.
It was, that didn't used to be Virgin. It used to be Hard Rock. Yeah, I think it was the Hard Rock.
Yeah, it looked like
So
it
it's
was
new.
redone recently.
Yeah.
Different flooring. You can tell the walls look older because they're real textured. You know what I'm talking about?
Yeah.
And almost I haven't looked. I think even the popcorn ceiling might still be up there too.
Well, you know what's funny is all right, just think about that, right? That hotel. It's how did that hotel get funded? They probably used
Probably
IRA
from an
money.
insurance company.
Money. For real. That's
Yep.
that's where the capital got. It wasn't from us. It was from some big insurance company funded it, or some big, it wasn't a family office probably. It was probably an insurance company, like you said.
Yeah, 100%. They got all the money.
Yeah.
I'm telling you, they
That's
got all
crazy.
the money.
It's crazy. Is there anything else people need to know that we haven't covered about insurance or these crazy ways what these elites are doing?
I mean, dude, we could go for hours. I'll need to take a potty break if we do that.
I don't. Well, you're already going to be late to your mastermind, but I thought the art thing is funny. I think the captive insurance is interesting. I don't fully understand it, but I've heard people do that, and I've heard it's just very complex to do. Another one I've heard is what is it called? It's land, not entitlement, but rights. Have you heard that one?
No.
Oh, okay. There's ones where you get these write-offs for I'm drawing a blank on what exactly it's called. But you could essentially buy land. Let's just say the land cost, I don't know, $100,000, but then it comes with $500,000 worth of rights. Maybe it's the mineral rights and stuff. And then it's the same premise of art. It's you paid $100 for it, and you can now just go donate the land and get, $500,000 write-off for the rights.
But then you own the rights.
Well, you'd be giving the rights to whoever you donated it to.
Got it.
In your case, if you donated it to your foundation, then yeah, I guess you still would own the rights. But the way I always looked at it was, okay, I mean, it kind of makes sense if because you did have to pay $100,000. So, I mean, consider that basically the tax. And so if you got a $500,000 write-off and you're at the 40% bracket, okay, you basically saved $100,000 because you had to pay $100 to do it.
Yep. So that's how mine was. Is my tax bill was going to be a certain amount.
Mm-hmm.
I paid $95 instead.
Yeah.
So it's I saved about $400.
Yeah.
Made sense.
Yeah.
The only thing is there's a maintenance fee. So every year for the tax attorney to maintain this structure, I think it's 15% of the savings. So like if you save $1 million in taxes, you got to pay him 150.
Dang, this dude's rolling it in.
He's doing all right.
Dude, I want this guy's job.
But you still saved 850.
Oh yeah, you ain't gonna be mad about it. I just want his job. I want this guy's business, dude.
I don't, man. It hurts my head sometimes even talking about it.
Yeah.
And this is all he does. He's been doing it for like 30 years.
Yeah.
You know? So, but it's definitely a cheat code.
With your guys' for you as a guy who has life or who's doing infinite banking, do you guys make a residual every year on all the client? Okay.
10 years.
10 years.
Yeah. So that's where just it gets good because the longer you're in it, longer you're in the game,
Yeah.
your renewals become just stupid.
Yeah.
I've only been in it for 3 years.
It's just going to keep compounding for you.
Yeah.
Do you make more though up front?
Yeah. First
Okay.
year you make the most.
Yeah.
And then year 2 through like year 5, it's considerably less.
Yeah.
And then like year 6 through 10 is
It goes back up.
it goes down even more.
Oh, it goes down even more.
Yeah.
Okay.
Yeah. So you make the majority first year.
Got it. But there's still a little residual.
Yeah.
And then are you doing any kind of like downline stuff?
Starting to.
Yeah.
Yeah, starting to. So building out teams and just different partnerships with. I've got like a husband and wife that have their own coaching platform for real estate, and they're getting a policy, and they're going to actually have all of their clients feed through my downline. They'll get paid commission off of all of them,
Yeah.
but then they'll be my downline. So I'll get like a
Yeah.
cut of everything. Exactly how Chris is doing right now.
Yeah.
With me.
If somebody wanted to get started, what's the minimum that they need? Like when does it start to make sense?
Really starts to make sense about 10 grand a year.
So you're going to contribute 10 grand a year. Do you have to pay like a fee on top of that, or is it like it's just 10 grand?
Just 10 grand. So you plop in 10 grand, you got access to probably 7 to 8 grand of it right away.
Yeah.
You use all 7 to 8
Because
grand.
the 2 to 3 is like the cost
the
of
cost,
doing it.
yeah, to get the death benefit.
Yep.
Yep. So that doesn't have any cash value right away. It does over time.
Yeah,
It
yeah.
takes like 5-6 years before that 2-3 grand starts building cash value.
Yeah, yeah.
But the overage, the 7-8 grand that you're putting in above and beyond, that's instant cash value.
And then the next year you put 10 grand again.
Yep. And then the cost didn't change. So you've got access to like 7 or 8 again, whatever the liquidity is, plus the growth from the 10 grand the first year. Right. Mm-hmm. And then once you start getting into where that 2-3 grand starts building cash value, that's when it gets good.
Yeah.
Because you're getting all the growth from the compound interest plus your overage that you're putting in each year, your paid up additions.
Yeah. So you're saying that 2 to 3 grand you're paying every year for your cost is starting to finally make sense in year 6, 7.
Yeah.
Okay.
Yeah.
So it is similar to what I was hearing before.
Yeah.
But it was just the death benefit.
They had
Is way
a
less.
higher cost.
Right.
So it took longer for that to make sense.
Right.
So the lower that is, the more liquid the policy is right away.
Right.
The higher that cost is, the more liquid the policy becomes later on, because you're contributing more later on. When
And that the overage money that you're putting in, does that get taxed?
no, there's no tax on any of the growth. No tax on the use, no tax on the growth, no tax on the death benefit. You just pay taxes when you put the money in. So it's like post-tax dollars.
Yeah.
Unless you have the foundation structure and trust structure like I have,
Yeah.
then I'm paying the policies with.
Yeah. A lot of these IRA account or retirement accounts are either pre-tax or post-tax,
Yeah.
right? So pre-tax would be, hey, you're not paying any tax. This is actually going to be like a write-off for you today.
Yeah.
Problem is, down the road, if it grows, you'll get taxed then.
Yep.
And then, post-tax would be, hey, I am paying tax on this money right now today, but its growth will be tax-free.
Right. My opinion, that's the best way to do it, because you know what the taxes are today. You don't know what they are in the future.
Well, and you're just expecting massive growth.
Yeah. Yeah.
So you would expect that if I put, I don't know, $1 million in, it's like, yeah, I paid tax on $1 million, but if I have, 10 million when it's all said and done, and I have no tax on it, like it's
Much rather have that.
yeah, versus 10 million on the tax, tax on the 10 million.
Yeah. Much rather have that.
Yeah.
It's the whole notion that people say like, oh, well, when you retire, you'll be in a lower tax bracket. Then you're just basically saying
I'm gonna be
retire,
broke.
You're going to be broke. Why
Yeah.
would you do that?
Yeah.
Right? Your whole goal should be when you retire to like live abundantly.
Yeah.
But also do it while in your working years. That again is why I don't really think like a self-directed is the best thing, because you can't fully control it while you're not retired before 59 and a half.
Yeah, you can't use the money to like live or anything.
Yeah.
Yeah. It's just pure investment.
Policies are great because you can use it for whatever, whenever. And then because of how long you've given it to grow, the compound interest is stupid. Like I've got policies where when I'm like 70, I'm probably not going to be working. I probably won't want to be working like crazy, right? Who knows? But at 70, I can put in like 50 grand. The growth is like 400 grand.
Right.
So I could put in 50, immediately take out 400 as a loan. Like that's,
Wait, repeat that. Go on.
so if I put in 50,
Yeah.
the policy grows by 400
Why?
because of the compound growth. The compound growth for my entire life up until 70 never stopped. I kept putting in that 50 grand a year.
Right.
So it's just more and more growth. So that year when I put in 50, bumps up by 400 grand. That's all the growth.
The
You don't-
lifetime benefit?
No, it's just the growth from the year prior. You don't have access to the growth until the end of the year.
Okay.
So like when I put in 50, I'm accessing all my growth from that prior year.
You're saying the prior year you grew 400K as far as like, because you've been putting in 50K every year for like 30 years,
Right.
right? And so what you're saying is, let's say your principal in is, what would that be, 50K? Let's just say 20 years. So $1 million, right? So you've put in $1 million and then it's growing with interest, compound. And so maybe the million is worth, I don't know, 3 million, 4 million, 5 million. I don't know.
Yeah.
So what you're telling me is like next, if it was worth 5 million this year, a year from now, it's worth 5,400,000.
Exactly. So now that's what's compounding.
Yeah.
Right. So then I'll have access to even more the next year.
Yeah.
So it's a beautiful thing because then as long as you keep paying premiums, you'll always have a death benefit.
Right.
So think about what I just said. If I put in 50,
And how much is the premium at that point?
it's the same. So the
Three
premium,
to the 2 to 3K.
yeah, it never changes. It always stays exactly the same.
It's like my term. It's just
Exactly.
It's 2 to 3K. That just
Exactly.
is what it is.
So like, let's say if that premium was 50 grand, like I just said, and it spits off 400 at 70 years old, I can just take of that 400 grand, 50 grand of it to pay next year's premium. I'm using the growth to pay the premium. I just keep the difference as tax-free income because loans aren't taxed.
Yeah.
So $350,000 at 70 years old, I just got as tax-free income, and my premiums paid for the next year. So I'm going to get
Because
even
you're giving
more.
it to yourself as a loan.
Yep.
Whether you pay it back or not.
And then 50 grand of it, I'm going to give back to the insurance company as premium.
Because you have to keep paying your premium.
As long as you keep paying the premium.
But you don't have to even pay 50 grand. Because your premium's 2 to 3 grand.
Exactly.
The 50 grand is just you wanting to keep growing it.
Yeah, you're just continuing to pay the premium so that it keeps growing.
Yeah.
And the numbers are arbitrary. So based whatever the numbers are.
But I'm just like, because the premium does not include you overpaying and overfunding it.
Right. Overfunding is only possible for like 10 years.
Oh.
Yeah. So like that policy I just explained, that's 125 I can put in for 10 years. After 10 years, so you're 11 for the rest of my life, I can only put in 50. That's the premium.
50K is the premium.
Right. So at 70 years old, if it grows by 400, I can just take that 400 as a loan, keep 350 of it as income, take 50 of it to pay the next year's premium. So then that next year, because I injected another 50.
Yeah, the 50K is though, that's just a sunk cost. That's just the cost of doing business.
But then because I'm continuing to add more premium, I'm continuing to get more and more growth. So the next year when I'm 71, it might be like 430,000. Take that, 50 of it pays the premium. I keep the difference, 380. So literally my income keeps rising the older I get, as long as I just take a portion of that.
It's because it's from the overfunding early on.
Yep. And it never stopped compounding.
And what's it being invested in? Just the insurance companies just paying you that guaranteed 3.25
Plus dividends.
plus the dividends.
Yep.
That's how it's compounding.
Yep.
And so you're taking the compound from that, just say 400K a year, and then you're using part of it to pay your premium. And you could keep it in there and let it compound even harder.
Right.
If you really wanted to. But
Right.
you're saying, hey.
This is more of like a retirement play.
Yeah.
So like when you retire, if you didn't retire till you're 80, 85,
It just kept compounding.
then it's just
Even crazy.
Exactly. So
Yeah.
it's delaying that gratification. Like my policies now are at a point where I could technically retire because they're growing more than the cost of the premium.
Right.
Like I just had one where we put in 125 it was 150. So it was a policy on my wife, put in 150, it grew by 177. So I could technically take the 177, 150 of it, pay next year's premium.
Your premium is 150?
That's with the overfunding.
Okay.
Okay, so that's the first 10 years. The premium 60, the overfunding is 90 grand,
Got it.
right?
And 150 is the max you could overfund at like a 90K or a 60K premium?
On that policy, right?
Okay.
Yep.
Got
So I could technically just have 27 grand of tax-free income right now off that policy, but then I'm stunning the growth.
Yeah,
If
it's
I
not
wait-
going to compound.
Yeah, if I
It
wait,
would kind of just stay the same.
if I wait, it would just be bigger numbers.
Yeah.
Yep.
That makes sense. Well, dude, actually that answered quite a few questions. Maybe I'll even tell Chris that, hey, my guy, Mr. Brrrr, he explained it better. And maybe I'll say that, maybe we'll have it on camera. I don't know. But I'd like to hear what he says about it.
You heard it here, people.
Just clip it. But no, that was insightful. I actually did learn quite a bit. And, if anyone wants to do it, we'll link your stuff down below. So definitely check it out, guys. And if you're interested in doing whole life, hopefully, by now, I probably asked every question you might be thinking.
You asked every question that everyone it's always the same questions. Yeah. So
I would like to think I think deeper than most people, but it's all good. I'll ask the basic. You know what? I was just thinking basic level for the people.
It's always the same questions, man. So like,
yeah,
once people finally get it, it's like it's the best thing since sliced bread. Once you finally understand it.
But I'll add as a caveat, the only way it really starts to make sense is if, you're starting to make money. Like you still got to make money in something, right? Like you got to have some kind of career or skill or business or thing that you're making money on.
It's not going to make you rich. It's not an overnight thing.
No, it will only make as much as you make over here.
Right. So you have to be able to fund the policies in order to be able to borrow against them.
Exactly.
So if you put in $100,
you ain't gonna be rich.
What are you gonna borrow? $70? Like you just can't do much. So that's why like 10 grand starts to make sense. The more you put in, the more sense it makes.
Yeah.
Because then you just have bigger numbers you can start
That means you're making more money over here too.
Right. So I always tell people they should have two businesses. One business is the business they make their money in.
Yeah.
The second is the business of banking, how that money flows.
Yeah.
And that's infinite banking. If it flows through a policy and comes back out through a policy, inevitably, you're just going to make a lot more money because your money's running in tandem.
Yeah.
You're making money in your business, whatever you do, flipping couches one time, right? Isn't it?
Dude,
You used to do
I'll
that.
flip that, yeah. I'll flip that couch you're sitting on right now.
I'll flip that.
Yeah, I'll flip anything, dude.
I'll flip that. But yeah, so like you make money in whatever you do.
Yep.
But then you also have your money making money in infinite banking.
Yeah.
So they're running parallel.
No, I understand.
So it's crazy once you really understand it and once you really get it.
Yeah.
And I've had the pleasure of helping 1,600 people do it. It's been cool.
Yeah.
Thanks for making it to the end. The good news is I've got another one that I know you're gonna like, and all you gotta do is click it right here. Linking it right here. All you gotta do is just click it, and you're gonna see this new episode that you're gonna love.
You need to triple down on what actually works. If you're doing really good with cold calling or texting or Facebook ads, double down on it. Don't just keep doing it at the same rate. If you've got a winner, ride that winner to the fullest. And on the flip side, if you've got a loser or something that's not working as well, then cut it out or slow it down.